How you guys doing? We're going to be talking tonight about put sales, one of my favorite strategies in the world. One of only three, but it's one of my favorites. Reach out to me, guys. Tell me where you're from. Edward, hello. Bob, Angela, Carolyn. Tell me where you're from. Where in the world are you tonight? Where are you joining us from? Wow, big list. New York, Rochester, Southern California, Colorado, England. Nice. Phoenix, Oklahoma, Florida, Arizona, British. Yep, Angela, British Columbia, Alberta, Sydney. Got our Canadians representing and our Floridians and our New Yorkers. Sydney, Australia. Wow, what time is it there in Sydney right now? It's got to be, what, early morning? Or is it late night? I always forget. Canada, Jacksonville, London, Toronto, Las Vegas, Ross, Tracy City, Tennessee. I know that guy. He and I share the same last name. New Jersey, hello, hello. 9:30 a.m. Okay, so it's Friday morning. Nice, nice. All right, so who's ready to learn about put sales? Yep, cool. All right, so one of the things I wanted to kind of start with is this picture of, this is a racing rig. Have you guys ever seen this before? This is a like a typical Oracle racing rig. It's a sailboat, and the sailboat can actually go 3 times faster than the wind. Now, why am I thought we're here, Matt, to talk about stocks. Why are we talking about sailboats? Well, bear with me, stick with me. So they have these little foils that they can deploy, and I'm not sure how the technology works, but these big sails work kind of a lot like a airplane wing. And so they're able to literally get speeds 3x of the wind. So if the wind is 10 knots, they're able to go 30. If it's 12 knots, they're able to go 36. And it's a really amazing piece of machinery if you think about it. But the reason I put this in here is a question for you guys. We all know it's been super choppy this year. 2020 is going to be like a year like none other that we've seen. So my question is, how do you get 3 times? How do you get a 3x return? How do you get a 3x return? So if the market is up 9%, how do you get 3x? If it's up right now, it's, who knows, it's up by 2%, maybe 1% on the year to date rather. So how do you make 3x market return? How do you get returns a lot like that sailboat? How do you get 3x? So the speed is one thing. How do you get returns that are 3x faster than the actual market itself? So, so I want to kind of talk about, a little bit about what this strategy, who this is for. So this is a strategy that is for people with some trading experience and some basic option experience. So we're going to talk a lot tonight about some terms and some terminology, some words and phrases that you may not necessarily be used to and accustomed to. And so I want you guys to make sure you have at least some basic option experience. This is not an options 101 class. This is more of an intermediate and advanced class. And if you're a brand new trader, you can still learn from something. Just sit back and watch. We are recording this. I am going to double check. Yes, we are. So this is ideal for someone who has at least a $25,000 cash margin account. Now, if you don't have a margin account and you're using like an IRA account, we're going to talk about some of the differences. So if you have a retirement account set up, you're able to use this strategy. You can't use the margin piece because retirement accounts don't have margin. I guess the IRS, the government, doesn't want you to be able to borrow against your retirement and make more money. I don't get that, but it is what it is. So if you have a cash secured account, like a retirement account, you're able to do that, but instead of like naked puts, they're cash secured puts. So throughout this class, I'm going to be talking about put sales. In my previous class, we talked about naked puts. And in this case, I'm just going to refer to it in terms of put sales, because put sales can work in either type of account, whether it's a cash margin account, which most of us traders have, and a more of a longer term IRA, Roth IRA account. Those are cash secured. But as far as the strategy, nothing's different. It's kind of like the relationship between you and your broker. That's what's different. So I'm trying to not use the term naked put. So the other thing is you do need, because this is an advanced intermediate strategy, you do need tier 3 or 4 trading experience. I am not going to cover spreads here tonight, Patrick. But this is what it looks like. If you go into, this is my TD Ameritrade account. If you go in, you'll see here that we have margin trading is enabled. And then my option trading is tier 3 advanced. I believe that different brokers, whether it's Merrill Lynch, Schwab, they all have different, they refer to it differently. But if you're interested in the strategy, this is kind of what you need to have in place to unlock this feature and kind of take advantage of this strategy. Everyone with me so far? Type a 1 in the chat pane if you're fired up, if you're ready to go. Okay, excellent. Excellent. All right, love you guys. All right, let's get started. So for those of you who are familiar with for those of you who are familiar with stocks, to place an order, you just need a few basic things. You need to know the symbol. You need to know the shares. You need to know if you're buying and selling and kind of an entry price, right? That's like the basic bare minimum to put in an order for a stock, to buy some shares of a stock. Now, options are exponentially more complex, which is why Jeremy and I typically want to make sure that someone's been trading profitably for typically at least 6 months to a year profitably before you try to jump into options. Now, there's nothing wrong with the new traders learning about options, but as far as jumping into live options trading, you want to make sure you know what you're doing. You want to make sure that you know how to drive the car before you jump, like a basic Honda or a Toyota. You want to make sure you know how to drive that before you jump into a Lamborghini or a Ferrari. Now, what difference does that make? Well, the Lamborghinis and Ferrari, yes, they go faster, but that's a double-edged sword, right? You can wrap that around a telephone pole. It's more dangerous, and it provides higher risk, higher reward at the same time, right? So when it comes to options, you have the same kind of thing where you have a symbol you need to know. You need to know the number of contracts that you're going to be buying and selling. Tonight, we're going to be talking about selling puts, selling put option premium. And as most of you know, one contract represents 100 shares. And then you also need to know if you're buying to open or selling to close. In our case here, we are going to be selling to open and buying to close, and I'll walk you through that. Obviously, with options, you have calls and puts. Again, this is not a option 101 class. It's a little more advanced. I'm kind of assuming you guys have some terminology down and you are familiar with some of these terms. Now, the strike price, you do have to know that. That's kind of an extra little exponential piece. Obviously, the option itself has a price as well, in addition to the strike price, and then you have an expiration date. So again, you have some piece of information that's a little bit more complex, a little bit more complicated. Again, you need to understand the basics before you get into the advanced. So this is an intermediate swing trade strategy. Where are all my swing traders? Type an S in the chat pane if you are a swing trader, or if you are what I refer to as a closet swing trader. You're a day trader trying to make it, struggling. You don't realize that day trading may not be your thing. It might be a swing trader. You just don't know. You haven't come out of the closet yet, right? Okay, lots and lots of swing traders. Yep, some CSs, some closet swing traders. Absolutely. I've shared my story before about how I started. I originally wanted to be a day trader. It was a struggle and a grind. And then I said, hey, maybe I should learn swing trading, and I'd make money swing trading to then turn around and give it back day trading. And so that was the easy fix, right? Just stop day trading, Matt. Come on. Hello. So that was the easy thing to do. So I ended up transitioning to just 99% swing trading. I do take an occasional day trade. And when I say occasional, I mean once every 6 months. So when I post my wins, rarely ever is there ever a winning day trade in there as well. And so I know some of you guys do both. I know some of you guys sell, or some of you guys are swing traders and day traders. Nothing wrong with that. As long as you enjoy, as long as you're profitable, do your thing. I'm just telling you what works for me and my strategy. Now, excuse me, some of you may know Some of you may know that I was the CEO for 14 years of a software company, and I sat behind a computer monitor 12 hours a day, all day, every day. And I did not want to necessarily be in front of the computer monitor day trading all day, every day again. Now, yes, the market's only open 6.5 hours a day, but you have your your pre-work before market opens, you have your post, after the market closes. And so the last thing I wanted to do is I wanted to call that financial freedom, where I was like glued to a computer screen. Now, of course, if I chose to do that, was my choice. I chose to spend time doing that. Nothing wrong with that. Absolutely. But I didn't want to have to do that. So I've kind of told the story before about how I started, and I had these big dreams and I got punched in the face, and I'm like, okay, maybe this isn't for me. And I ended up kind of drifting into swing trading. So next, put sales in 3 steps. So here is, we are recording this, guys, but if you want to take some notes, I'm not going to complain. I love my note takers. That means you're paying attention, you're interested, you're ready to absorb these nuggets. So put sales in 3 steps. Number 1 is build your watch list. So I like companies that have grown 30% their revenue growth 30%. And I'll show you on a watch list here how to look at this. And the other thing is I like them to be above a 200-day simple moving average. Now, the significance of that is that a long-term moving average, the 200 simple day moving average, most of you know, if a stock closes below the 200-day on some of these stocks, like some of these that are on my list are coming off the list because they're closing below this. But some of these are, when you close below that long-term support, look out below, right? Things typically tend to get a little shaky below there. So that's kind of like a last stop for bad things happening. So you want them to be above that kind of last exit ramp on the going nowhere highway. So number 2 is you want to wait patiently intraday for a dip. Now, I have an indicator that I will share with you guys. Actually, can someone post that in the chat pane? I apologize, I have that somewhere. Let me get that for you. Here, actually, I got it. Here we go. There we go. Yeah, Edward, that's the watch list. Yep. So there is the indicator for those of you who use TradingView, and I'll show you how that works in just a second. But what we want to do is build our watch list ahead of time, and then we want to wait for those dips. Now, how many of you guys know the last week or week and a half, we've got some dips? So what does that mean? That means we got a green light to go to the next step. The next step is check our premium using a 1% formula. So when I say 1%, I mean 1% per month. So for example, we're sitting here at the end of October. So our next month would be November. So between now and November, that would be 1 month. I would look for 1% premium. To go to December, 2 months from now, I'd look for 2%. So to go to January, I would need what percent? What percent would I need, guys? Talk to me. 3%. Yep, that's right. So again, you can go out as far as you want. I typically like anywhere from a few months to 3, all the way out to 9. I typically don't go farther than that. Now, this is the basics of the strategy. This is what you're actually doing. If you think about it, if you want to take a concept and put around this, what you're essentially doing is you are selling insurance. You are the insurance company, and you're selling insurance for a shareholder at a set price. And it's a time. So if you're selling a 2-month insurance policy, that's going to be cheaper than a 6-month insurance policy. And that's going to be cheaper than a 12-month insurance policy. You guys follow me? So essentially what you're doing is you're guaranteeing a price. You are guaranteeing a sales price, which we are calling it, which is called a strike price, at the predetermined time, which is an expiration date. So for example, I have some positions now where I have a few that expire at the normal monthly option on November. I have a few that expire in December, and I have a few that expire in January. So I sold 1%, 2%, and 3% for each of those respectively. I typically like to sell options and be mindful that I don't want to sell I don't have a ton of positions all sold that expire in November or December. I don't want them all kind of lumped together and all expire at the same time. Now, why is that, guys? Why would I not want that? Why would I not want to have all my positions expire the same day? Right, I could get exercise, that's right. Now, if I stagger them, if I space them out a little bit over a period of months, it's literally not possible for them all to expire and be put to me, correct? So as a option seller, this is the exact opposite of option buyer. As an option seller, I am guaranteeing someone the right to put the shares to me, right? I'm guaranteeing, I don't really have any rights. I have obligations. I have a liability, correct? Now, when it comes to the 1%, guys, the 1% is wherever the stock price is currently. It's not based off of the strike price. It's 1% based on the current price. And I'll show you guys some examples on the chart here in just a minute. So I want to make sure, oops, let's go back. And then so let's say that Fastly is down, has been down a couple, 2 weeks. If someone bought a put, they're buying it and they have the right, not the obligation, they have the right. So on the buyer side, you have the right. On the seller side, you have an obligation, right? So as an insurance policy buyer, so if you think about your car, your home, if there is a policy, if you buy a call policy on your car, if you get in a wreck, it's up to you whether or not you want to turn that in and turn it into your insurance company. Maybe it's a fender bender, you want to throw some spray paint on it, whatever, which I don't recommend, do it right. But if you want to turn it into your insurance company, you have the option. Now, as an insurance seller, as a option seller, as a premium seller, I have an obligation. So I am required, no matter what, I'm required to do it. They may or may not ever put it to me, and I'll show you why they may or may not in some examples here. But essentially what I'm doing is I am shorting a short put. Right. So I'm sorry, I'm shorting a put. So you have there's long puts. If I was to buy a put, I would be long a put. If I'm selling it, I'd be short. So I have a short put. And you guys may remember in English class where you have a double negative is actually a positive. So if you're not doing something, that means you are. That's kind of what this is you're shorting a put, which means the double negative in a way, which means I'm bullish. Now think about that for a minute, guys. I'm shorting a put. So the reason so you can do a few different things, but shorting a put allows me to have time decay work in my favor. And I'll talk about that in just a second. So essentially what I'm doing is I'm selling it at a premium. Let's say I'm selling a put, and I got some examples at $8, and I want to buy it back at a less amount. So if you guys have a car, a classic car, Xochi recently sold a car. If you're selling a car, do you want to get as high or you want as much money as possible, right? But if you're a buyer, you want to pay as little as possible. So on this side, we're on the selling side of this. We want to get as much premium as possible. We want as much as we can for that classic car. You guys follow me so far? Again, it's a bullish strategy. Yep. Okay, so let's pretend, how many of you guys like Shopify? I like Shopify. I compete against Shopify in my previous company when I was a CEO, and we did not fare well against Shopify. So some guys wanted to take my headache away from me. My headache called the company, and they bought it from me. So Shopify, let's pretend you bought 200 shares of Shopify at $300 in November. So roughly almost last year. Okay. And let's pretend that the stock has grown $230 in your favor. Okay. So again, we bought shares at 300, right? And let's fast forward a few months, and it's now gone up $230 per share, right? So it went from 300 to 530. We've gained 230 per share. Now, because we have 200 shares, 200 times that is this guy right here. So how many of you guys would like to see a positive unrealized P&L, or realized or unrealized P&L on a trade, 46,000? Give me a yes in the chat pane, or a heck yes. Okay, so it's actually not that hard to do, right? To just buy a couple hundred shares, sit on it. And in this case, actually, this is true. These are true numbers. When I was preparing this class, I actually went back and captured the real numbers at some point in time. So at this point, guys, would y'all agree we're feeling pretty good, right? We're like, yes, I'm amazing. I know what I'm doing. I never have to ever back trade ever again, right? No, that doesn't actually, no one should ever get to that point. You guys know that Jeremy spends hours and hours back trading every month as well as I do. So then what happens, guys? Well, then let's say you roll to I'm sorry, here's a screenshot of it. Is you have a limit buy. So we bought 200 shares, boom. And we're sitting on it and we're up to 530, right? You guys see, I didn't leave the time frame in here, but it's about 2.5, 3 months, right? Everybody is feeling pretty good. We got our gains. We haven't locked in, right? It gapped up over earnings, kind of gapped up, went higher, and then faded the rest of the day, right? We're feeling pretty good. We got a nice gain kind of built in, correct? Again, let's review. 200 shares, 300, 3 months later, 530, feeling pretty good, yes? So let's say we got 46,000, we're feeling good. We want to go to Canada, or we want to go to Italy. We want to go to the island of Capri for a month, right? How many of you guys have ever been to Capri? It's amazing. It's a little island off the coast outside Naples in Italy. Yep. So you're feeling pretty good. So you want to disconnect from the world. You want to just live life, enjoy life, right? Maybe take the kids, the grandkids. You want to go on this amazing adventure. You want to go to Capri for a month. You come back from your trip, you look, and your big earnings have now been chopped in half. And you're like, what in the world has happened? So again, we bought 200 shares, $300. We were up 530. We were up we were up 230. The price had gone from 300 to 530, and it's now 400, which means we just lost $130 per share. Now, we were living high. We were on vacation. We were, visiting this amazing island, good food, good drink, good conversation. And then we got this nice present the day we get back, and it totally ruined our vibe. Like the Zen feeling just gone, right? Bye-bye. So what do you do? What do you do? Well, guys, most of you know the best time to buy something like the best time to sell a house alarm system. If you think about it, when's the best time to sell it? Is when the emotion level is high. So the best time to sell house alarms is when? It's after you've been broken into, right? It's after you've been broken into. So when people are scared, that's right. When the emotions are high, that is the best time. Now, do you think that's different when it comes to options and buying protection? No, that's actually the same. It works the same way. Now, for some of you who mentioned selling, you can sell covered calls, but it's best to sell covered calls on the way up, not on the way down. You can't capture the maximum premium when you sell on the way down. You may or may not get any decent amount of premium on the way down, but you want to sell covered calls on the way up. In this case, we want things to come down so that we can capture that fear. We want that implied volatility, that fear factor to be high, because again, we are the insurance company and we are selling stock option. We're selling stock premium. We're selling protection, right? You guys with me? So yeah, when people are scared. So what happens? What do we do? What do we need to do, guys? Well, let's say that we were up here in this level. We were right up here feeling good about ourselves, go on vacation, and boom, we are down here. So the shareholder, like you, if you're the shareholder, you're thinking, wow, profits have disappeared in a month, the world's going to end, right? I lost half of my not quite half of my $46,000 profit, right? I actually lost a little bit more than my half of my unrealized P&L, right? So what do? You can buy a protective put. Now, you've heard Jeremy say, buy a protective put over earnings. Now, people ask me all the time, do I hold any of my stocks over earnings? And the answer is typically the same. There's a few rare occasions. What's the answer? The answer is only if I have enough of a profit cushion. What does that mean? That means I want that trade. I want to be able to, that trade should be able to finance its own life jacket when we hit the rapids and we don't really know what's up ahead, right? We put a little life jacket on our position, and I want that position to be able to finance and afford its own life jacket to go down the rapids and maybe over the cliff. Who knows? You guys have traded earnings enough to know that who knows what's going to happen. You're going to have good earnings that go down, bad earnings go up. It's hit or miss, right? So what happens is we take we kind of take advantage of their emotionalness right here. And we basically make an agreement. We say, hey, you pay me money and I will guarantee a 400 strike price. Now, how did I come up with $400? So for those of you who have TradingView, you'll notice this thick green line right here, and that represents, and my indicator that I pasted, that represents the strike price. So this is when you want to sell. I'm sorry, not when. This is the strike price you want to sell at. And we're going to back trade this, and we're going to bring on someone on to see if we can kind of play this out in real time so you guys can see how this works. Not in real time, but going back. Obviously, the markets are closed. So we're going to play this out and show you how this works. So the first thing you need to know is that this blue line here represents a 10% pullback. And it's all built into my indicator. It's the Naked Put Growth version 2 indicator. It's all built in, and I will show you guys how this works. So what we're looking for is, on a daily basis, we're looking for a dollar sign. Now, what does the dollar sign represent? You guys remember from one of our previous slides, how much of a pullback do we need in order to trigger this? You guys remember? No, not a 25% pullback. We need a 4.5% pullback. Now, the 25% represents, Tracy, it represents the strike price we're going to sell at. Now, for those of you who look closely, you'll notice that 400 is a little bit below. They may or may not have like a 4, I don't know, maybe that's a 410. There might not be a 410. So this is like the highest strike price I want to sell. So what we're looking for is a dollar sign to appear. That's number one. Number two, that gives us the ability to go check our premium. So I've been doing this a few years now. I started trading at the end of 2015, early 2016, full time. And my superpower is whatever mistakes can be made, I am really good and really quick at figuring out what are all the wrong things to do. Okay, it's my superpower. I'm really good at it. So I figured out how not to do all of this. And again, I'm sharing it with you guys. So one of the things I did learn is that it's really easy to sell premium when the fear factor, when the implied volatility is high. Again, when we're selling option premium, we want to get as much as possible for it. So again, if we're an insurance company, we need to think about what makes sense to take risks on and what doesn't, correct? So if I was to sell premium on this day right here, do you guys think that I will get top premium, yes or no? Will I get top premium as an option seller, yes or no? Some say yes, some say no. Jay Linder, why yes? Why? Michael C, Deidre, why yes? Why would I get top premium? Depends on when I sell it. So let's say I sell it sometime in the middle of the day, right? You got a little, obviously you had a lower and upper kind of shadow, some buying and selling pressure on that candle. So people are scared. Yes, they are scared, but look, guys, we almost were, the previous day was almost at all-time highs right there, right? So like all-time highs yesterday. If you think about it, as far as people are trapped, I mean, you got like, you're trapped from like 4 or 5 days ago. You're going to get option. You're going to get top dollar. The fear factor will be elevated. I don't know if it would be high. So what I did was I built this blue line. This blue line represents a 10% pullback. So the 10% pullback just tells me, hey, Matt, I want to wait for, I want the move at least to come back and pull back below. Oh, shoot. Please wait. So I want the pullback to come down, and I want it to pull back below and kind of pierce and penetrate this blue line and come down into this sell zone, which is this green shaded area. That's the ideal sweet spot. So although I got the green dollar sign, I'm probably not going to get the premium. Now, step 1 was build your watch list. Step 2 is the pullback. Step 3 is check the premium. So in this case, I'm probably not going to get lots of premium. But what about over here on this day right here? See how we pierced the blue line? So which means we're down. The blue line again is 10% from its recent high. So it's a simple calculation. What I do is I look back, I think it's 200 days, and I say, what was the highest close going back 200 days? So if you look on the chart, this candle right here is probably the highest close. And I say, okay, what's 10% below that? And that's essentially what the blue line is. So you want to sell somewhere between the 10% and 25% pullback. So in case you're tired of calculating all that and trying to figure that out in real time, spreadsheets, I made it super, super easy. All you have to do is look here on my indicator and say, is it in this green shaded area? So on this day right here, we got the green sign. We can go ahead and check our premium. Now, the next day, we kind of go a little bit higher, then we gap down and go a little bit lower. Again, we got our green sign, we're ready to go. Now you'll notice that we did kind of chop around. We went a little higher and we went down even lower a few more times. So again, green sign, the green dollar sign appears intraday, okay? And the green dollar sign represents a 4.5% pullback. Now, some of you asked me, how exactly is 4.5% of what, right? Anyone have that question? 4.5% of what? So what it is it is based on 4.5% from the close of the previous day down to the low. From yesterday's close to the low. Now I call it an intraday pullback because this is something you can set up intraday, and I'll show you how to do that here in just a second, but that's typically how that works. So does everyone have any questions so far before I continue? Anyone have any questions? Hit me with your questions. Or otherwise just let me know you're out there, you're not asleep on me. Just say, got it. Blue line is above back mini candles. So the blue line is above. I'm not sure what you're saying. Yep. Okay. We good. Okay. Excellent. Excellent. So next we have, but here's how you build your watch list, guys. So I use finviz.com. Finviz is I use the free tool. I used to be a premium member. I use Finviz as a free tool. And I'll show you how to do that works in just a second. And you can basically run a screener, which basically looks for companies where the sales quarter over quarter is 30% or more. So let's stop right here, guys. What is the significance of 30% revenue growth? How many years will it take if a company, let's say they do 100 million in sales, they're growing 30% or more, let's just say 30%. How many years will it take for that 100 million to turn into 200 million? How many years will it take for the company to double its revenue? Quentin, Tracy, yep, you guys got it right. It's 2.5 years. Now, if you think about it, how is 30 times 2.5 equal double? Well, you got to think about the exponential building of that 30%, right? So year one is 30%. Year two includes the original plus an extra 30%, right? And so it's give or take about 2.5 years. And it is based on the quarter. So if you look in Finviz, the sales QQ is quarter over quarter. So for example, if we are sitting here in October and we're reporting second quarter earnings, right? We're reporting second quarter earning. It's comparing the second quarter of this year compared to the second quarter of last year. So it's Q2 of this year compared to Q2 of the previous year. Now, here's a trick question for you guys. If a company is growing 30% a year, every quarter, how much are they growing in a year? How much is their top line revenue growth for the year if it's quarterly 30%? Do not use projected, it's actual reported. Yep. Anyone know? No, it's actually quarterly because I have to grow 30% per quarter for the 30% for the year to, right? For the year to grow, right? So 30% this quarter, 30% next quarter, collectively is 30% for the year. Now, the other thing, like I mentioned, is the 200-day moving average, which as you guys can see here is this nice red line right here, which means, hey, not only do I want it to be in this sell zone area when I sell the put, I want to wait for the green dollar sign, and I want it to be above my 200-day moving average. Now, I do like stocks that have at least $500,000 of average volume traded daily. Now, the question is, why does that matter? Why does that matter? Well, for those of you who've traded options a lot, you know that if a stock trades 500,000 shares a day, the options market for that stock is usually quite a bit less than that, right? So if you're trying to get in and out, if you're selling a put, you need someone to be on the other side buying. If you're buying to close, you need, right? You need to work through all the volume, make sure that you can get in and out easily and that there's no liquidity risk. Now, companies that meet all these requirements are typically in the tech sector. Now, is that how it is? Sometimes technology grows way quicker. You can scale it way quicker than manufacturing. Why? Because you can fire up more servers, right? You can set up more devices. You can spin up new servers on Amazon Web Services. You can, wherever you host things, and you're able to do that very, very quickly and scale it quickly. Whereas in manufacturing, you have to set up plants. You have to set up assembly lines. There's a process. It's time consuming. It's capital intensive. Software, you just click, sometimes you click buttons or it scales automatically. So you obviously spend time setting it up, but in the front end, but that's typically how it goes. So I typically like some non-tech companies in there. There's not a lot of non-tech companies that are growing this quickly. Now, think about it for a second. We pause right here. The tech industry typically has high margins, right? So if I was to generate a Tesla vehicle, I might make 20 cents on the dollar. So for every $1 of revenue, it costs 80 cents to manufacture that actual vehicle. Now in software, it's kind of flipped where in order to generate $1 of revenue, it might have only cost you 10, 20 cents, right? So it's flipped. So not only are they typically high margin companies, but the high margin companies growing very, very quickly. Now, the other thing you got to keep in mind is I avoid biotech companies. So if some of you are already looking at the FinViz screener, just make sure that you kind of ignore any biotech companies. Now, why do I not like biotech companies? They have this really bad habit of randomly announcing things, kind of like an unplanned news event where they did or didn't get approval from the FDA for drug research, for, approval to manufacture their drugs, whatever. I don't like the randomness that comes from biotech. So I typically stay away from those. So next, oops. Oh shoot, in my screenshot, it came. Let me see if I can. All right, there we go. So here is where I typically look. And so this is a screenshot of FinViz. And if you're looking at this, you'll see that the sales quarter over quarter is here. And the sales quarter over quarter, does this meet my minimum 30% for the quarter? Now, this is a live number as of, I think I took a screenshot maybe a month ago. 97.3%. Yep. Now, is this above my 200 simple day moving average? Yep. Now, for those of you, put a SB in the chat pane. If you've owned a small business before, something that had employees, you had some decent revenue, maybe $1 million or more, put an SB in the chat pane. Yep. Yep. So we got our small business owners out there, our entrepreneurs. Love you guys. That's my people. So imagine, guys, imagine having $2 billion in sales, okay? 2 billion. We'll just say that's a lot of zeros, okay? And it is growing 97.3%. Now, can they do that every quarter? No. Now, part of it was COVID was a spectacular event for companies that are cloud-based, cloud servers. It was an amazing event, which means if you're in the right place at the right time, things can go really well for you. So that is kind of what I'm looking for. And the other thing, some of you may or may not know, but you can actually tell just by the statistics down here, whether or not it's above the simple moving average, right? So there's a percentage there that represents how far above the moving average you are. Now, the other thing is the average volume is 2.46 million. Does that meet our 500,000 criteria? Yes or no? It does. It does meet our criteria. Absolutely. Absolutely. So let's continue. There we go. I got my remote working now. Yes, finally. Okay, so let's say that Shopify is here, and let's say that we are kind of looking at the big picture of what Shopify has done and how well this strategy has worked over time. It's warm in here. I apologize. All my electronics are going sweating up a little bit. So if you were to look at the green sign here, what we're essentially saying is, hey, this Shopify is on our watch list number 2. We're waiting for the intraday pullback. I'm sorry. Shopify is on our watch list number 1, right? It meets our criteria for when we build our watch list ahead of time. Shopify to this day is still on my watch list. And I've probably made more money off Shopify than any other stocks combined. Probably need to study my different accounts to look at that, but it'd be a close number, if not. Number 2, intraday pullback, but we need to be below our blue line. We got a signal here. And then number 3 is what? What's number 3, guys? We need to check our premium, right? So I do not have any restriction, Tracy, on how far away it is from this, at least in my case, the red 200-day simple moving average. I do not have any restrictions on that. No. Okay. Any other questions? Great questions, guys. Okay. Yep. You're welcome. Okay. So do you become more aggressive with selling since VIX is at a 35 to 40 take advantage of it? I don't. I don't. I'll show you a little bit more about how I think about this, but no, I don't. Do I sell below the zone? Yes, that's a great question, Mason. Sometimes I do, and I'll show you guys an example here in just a second. So after I have gone through this and I have identified the things I want, what I do is I will now check the premium. So I wait for the dip. Again, the dip is 4.5% intraday because we're taking advantage of that fear factor, right? And that's key to collecting premium. So let's say that I am going to now check premium to see that I get a 1% rule. Now, my typical rule, my typical guidelines are sell to open, put option 3 to 9 months until expiration. Okay. Number 2 is as you guys can imagine, going 6 months into the future versus going 12. The farther into the future you go, the more premium you can collect and the less capital is required. Now, why is farther into the future mean I'm using less capital? Ron, that's a great question. I'll get to that in just a second. About the alerts. You can use this for, so I haven't tested weekly options, but I don't see any why not. You do need to be really careful, guys, especially in choppy environments, especially if you look at the Qs and SPY, it's looking a little choppy out there. Okay. Now these, what I'm showing you guys, we'll call this in fireworks terms, I think this is like a class C firework, meaning it can get off the ground and it can explode, and it can explode in your hand. You have to be really careful with this, especially when you're loading up lots and lots and lots of options. If you're selling hundreds of contracts, you have hundreds of contracts of open liability. So again, if you guys want to play with this, I highly recommend, before you put any real money into this, I recommend you at least back test it, if not paper trade it for at least a couple months. And you can see how this works over time. You can watch how the P&L works. And the P&L is a whole nother specialty. I'll show you that. I got some slides on that in just a second. So the premium doesn't evaporate as fast. So part of why you need less capital is because you're collecting more premium. So for example, if I sell, let me get my tool. So guys, let's just talk about this here for just a second. Let's say that this green line right here represents the 850 strike, okay? And let's say that I collect, I don't know, $15 per share, okay? So let's say that I collect $15, 850. what is my actual cost basis? If I collect $15, my actual cost basis is, yep, that's right, $835. So so it's $835. So then how much if if one contract represents 100 shares, how much money do I need kind of on reserve for that liability, the open liability? How much money do I need? $83,500. That's correct. Now, what happens if I go out 6 months and instead of collecting $15, if I'm going out 6 months and instead of collecting $15, I now get $60. What is my cost basis now, guys? It's now $790 because I'm getting a bigger chunk of money, right? So it's my strike price plus I got like some premium I collected, put in my pocket. So if my strike price is still the same, still $850, and I'm collecting $60, then what is my cost base is $790 again. And now instead of needing 83,500, I now only need 79,000, right? So I got a little $4,500 extra premium that I collected, which kind of offsets my liability a bit. Now, some brokers are different. My very first broker that I used was called Centerpoint Securities, and they were cleared through Vision. And the way that they handled it was, if I got put shares, I would open my account and my actual cost basis would be my actual cost basis. I've seen on other brokers, it's two separate trades. Like you get the premium no matter what, but then your average cost basis might actually be $850 instead of $835. Either way, it doesn't make that much difference. You collect the premium one way or another. So again, we're looking to go out into the future, 1, 2, 3, 4, 5, 6 months. And again, we're trying to collect premium that is based on the risk that we're taking. In our case, we want 1% per month, right? So if we're going out 3 months, we need 3%. We're going out 5 months, we need 5%, right? We're going out 9 months, we need 9%. So again, this is, in our example, this is this does not apply. We can stagger expiration dates so that it's not possible to get all shares in the same month. Any questions so far? You guys with me? Okay. Excellent. So I won 1% for a month away. I went 2% for 2 months away, 3% for three months away. Now, what makes up? Have you guys ever thought about like what are the raw ingredients? What is required to make option to make what makes up and consists of the option premium? So I'll get to your questions in just one sec. So for option premium, 3 things: time, whether it's in the money, at the money, or out of the money. Again, guys, we're not talking about the basics of option here: in the money, at the money, out of the money, and whether there's IV. Excuse me. So time is pretty simple, right? How many months into the future are we selling an option contract? Are we selling 1 month? That's a small amount of premium. If we're selling 12 months, that's a bigger amount of premium that we can collect and put in our pocket. Now, they're double-edged swords, right? The time that you're selling for, the expiration day, whether it's 1 month or 12 months, the time is based on there's a double-edged sword, because the longer time you sell, the bigger liability they have open, right? So you may only want to sell 1 month, 2 months, 3 months. We only have a liability open. In most brokers, especially cash security, if you have an IRA, your cash security account, that money is kind of put on hold. And most brokers have like a maintenance dollar amount you need to have minimum in your account. And so that's kind of the double-edged sword there when you're selling time. The at the money, in the money, and out of the money, I'll touch on it really briefly and we'll fly through this. In the money, at the money, and out of the money. So if I'm selling, let's go back 1 sec. Let's go forward actually. Clear. Okay, let's give you a visual example. So in this case, guys, we're talking about the context of what we're talking about is we're talking about put options. In this case, we're not talking about call options, we're talking about put options. So if something is at the money, and let's say that that the price closes, let's say that this candle closes right here, it's kind of at the money. Now this represents what? This represents my strike price. This is where I'm going to be exercised, right? This is going to be the minimal amount, the maximum level that I'm going to be exercised. Now, some of you asked about premium pricing. Can you do that when put option premium? You can do that when you're back trading. John, I do have some stuff I'm going to show you inside Thinkorswim. There's an on-demand feature. You can go back in time. And if we have time, I'm going to walk you guys through how that works. So Tracy asked, what happens in a massive market dip if people panic and they want to exercise their puts early? Again, you have no choice. You have an open liability. They may or may not exercise it. It's up to them. So some people may exercise early. So if I'm selling a 12-month option, someone could exercise it immediately or within a few weeks or months. Obviously, they have 12 months. They paid a premium for that. It's literally up to them. So in a massive market dip, you have to be very, very careful. And that's one of the reasons why Jeremy and I both say that you should not be selling puts at all-time highs as far as the market's all-time highs. Why? Because it's going to have some pullback. And if the market has some pullback, overall market, the overall feeling, the overall sentiment has a pullback, then you know that your stock that you're selling puts on will probably see some pullback as well. So let's talk about this a little bit more. At the money basically means the stock is going to close right at near the money, at the money, right near my stock price. If I'm providing insurance and the stock closes down here, yes or no, would I be exercised if I sold this strike price? Would I be if I sold this strike price, would I be exercised if the stock is down here? Guys, yes or no? Here's my terrible candle drawing. I absolutely would be put the shares because I'm guaranteeing this level and it went below this level. So I would wake up the next morning and my brokerage account the money would be for the purchase of the shares at whatever strike price in premium, and it would be in my account. My put option would have been flattened and I would have some shares of the underlying stock. Now, what if same thing in reverse, but what if I sold here and it closed up here? Would I be in the money, at the money? Would I be exercised? Would I be exercised? Or we'd be out of the money, right? So if you think about, this is how I explain options. If you think about, these terms really confused me at the beginning. And if you think about a coupon, if you think about like going to the grocery store, whether it's Kroger, Albertsons, whatever grocery store, if you think about having a coupon, and let's say that you are able to buy a $20 item, okay, but you have a coupon for $5 off. I'm sorry, $5 off. Okay, so in this case, you have $5 that coupon represents $5, right? So you can literally buy it for $15, right? So it has some value. Now, what happens if you have a coupon for 20? I'm sorry, you want to buy the item for $20, but your coupon says, hey, you can buy it for 30. Well, what would you do? You would say, well, why would I do that? Why don't I just buy the actual thing, right? It'd be out of the money. It doesn't make sense. I would just buy the actual item. So that's how I think about coupons, how I think about out of the money, in the money, at the money. Is there an actual value built into it? And in this case, because we're providing insurance, and in this case, we're selling the insurance, there is a real dollar value that's built into this, that someone saved themselves some money, assuming they didn't spend a lot on buying the protection. Does that kind of make sense, guys? You guys with me? Okay, so some of you guys asked about, am I trying to get the shares put to me? Am I just doing it for income? You could literally do it either way. I combine this with a few different strategies. And if you just want to sell the put option premium, you absolutely can do that. The one rule that I would say, and make sure I need to get this in the recording, is this: do not sell option, do not sell put options on stocks you do not want to own. Why does that matter? Well, if you say you want it up here and stock goes to zero, guess what? You have a liability, right? You have to buy it. The money comes out of your account, or you get a capital call, or something happens where they get the money from you one way or another. So again, do not sell put options on stocks you do not want to own. Well, some people would say, I want to own it at this price, but I don't want to own it down there. Well, there's ways to mitigate that a little bit, and I'll get into that here in just a minute. But at the end of the day, you're guaranteeing a certain strike price. You're guaranteeing a certain level, right? So, okay. Oops. So here's a question that comes up a lot, Matt. Why do I like growth companies? They have a special place in my heart. I'm going to have fun here tonight, guys. So revenue growth companies are favored during bull markets. I'm not sure how you define 2020. We'll just call it a wild market, right? Everything was going good until COVID, and then it went down, and then it rocketed higher, right? I'm not sure how you define 2020, but at the end of the day, these are favored during bull markets versus a cash generating company that is paying out dividends, right, during bear market. So this is the other thing I like is that 30% revenue, and that's based on the price to sales ratio, which we looked at earlier. So valuations, meaning like the market cap, is based on it's tied to revenue growth. So a company that is growing 30% a year is a different multiple than a company like Shopify that's growing 90% a year. Now, Shopify, just so you guys know, is not growing at 90% a year. Their most recent quarter was that number, right? Once their numbers come out for each quarter, that adjust at the end of, I think it takes FinViz maybe 5-6 days for it to update. So whatever their most recent quarter was that came out, that'll be reflected in the numbers several days later. And again, 30% revenue company, doubling every 2.5 years. Now, for those of you small business owners, how would you feel if you doubled your business every 2.5 years? You'd feel pretty good, right? Right? Yep. Is there a point when valuations cap out? No, as long as people are buying the stock, it's pushing those higher. Yep. And again, guys, these may or may not be profitable companies, and they rarely pay dividends. So let me stop for a second and explain why they don't pay dividends. So most of you may know that a stock, when it's paying a dividend, there's excess cash that is available to rebate back to customers. And these young, small, growing companies, what they like to do is they like to go buy other companies, right? You have Tesla, they're buying companies. Shopify, they're buying companies, right? So if you're Shopify, you're looking at warehousing solutions, you're looking at fulfillment, you're looking at maybe artificial intelligence, you're looking at analytics. There's all kinds of things that they can buy companies with all that excess cash. Now, if a company is paying a dividend, they're kind of throwing up the little white flag saying, we don't know what else to do with this, so we're not going to be growing quickly. We're going to be rebating that back to shareholders. There's nothing wrong with that. It's just a totally different strategy, totally different approach. Okay. So if you want to think about the way, if you want to put a visual on this side by side, this is kind of how this looks. As growth companies, the ones that I like, right? The growth companies, let's draw a little heart over here. They may or may not be profitable. Their values are based on revenue growth multiples, which is that PS ratio, which if you guys know much about venture capital or private equity, two different approaches in a similar space. These rarely pay dividends. Here's some examples: Shopify, Alibaba, Square, NVIDIA, all companies that real life trading trades. Okay. Now the opposite, we'll call it the diagonally opposite, are companies that are more of a private equity, right? So you're buying companies based on cash flow. You want you want them to be, and obviously you can't have cash flow, a positive cash flow. You need to be profitable, right? So it's based on the earnings, and you guys are familiar with the PE ratio. I don't really touch these kinds of companies. When people ask me about what do you think about X company or Y company, I typically, if they pay dividends, they're probably going to be on this list. It's kind of like an automatic rule of thumb. Nothing wrong with this. Every single one of these are or were Warren Buffett companies. Okay. Every single one of them. So if I wanted to side by side, here's our comparisons. Does anyone know this guy's name? This handsome young man on the left. What's his name? Actually, one of our traders has met him and knows him and his family. He is in Canada, and you'll recognize the S as in Shopify. Tobias Lutke. Yes, Thomas Wong. Exactly. Tobias Lutke. I think he is one of the few billionaires in Canada. As you know, Shopify is based in Canada. Now, this is a growth company. This is what Matt likes. This is near and dear to Matt's heart. Now, there's nothing wrong with cash generation companies. Now, this guy right here represents cash generation companies. Two different schools of thought. There's no best way, there's no right way. Two different schools of thought and two different approaches. Warren Buffett is probably the most well-known investor probably in the world at this point. So he was the richest for off and on for several years, but lots of people are reaching up, catching him and passing him, like this guy you may have heard of who started Amazon, Jeff Bezos. Okay. So if you were to look on FinViz, this is kind of what it looks like. So this is a growth company. So you're seeing this column here, the sales quarter over quarter, guys. You see every single one of these plus 30%, right? And rarely do they, if they pay dividend, it's minimal. But if you look at something like NVIDIA, just a little bit of a dividend that they pay out. So again, this is kind of a snapshot. This is what it looks like for growth companies. This is a snapshot of cash generation. Now, this obviously has some COVID things built in. How do you know? Do you guys know that 88% down in a quarter? It doesn't get too much lower than that, guys. Now you'll hear me say, well, I don't like airlines. They're not. So if companies struggle during the good times, how do you think they're going to fare during the bad times? Think about that. There is ways to get historical sales quarter over quarter numbers. I believe there's some premium services you can subscribe to. I'm trying to think of one. Email me. I'll see if I can hook you up with one. There's not a free way to do it. There's a premium service that are a couple $100s that you can subscribe to. But you guys see the picture here. You guys see the difference. We do not have 30% here. We have less or negative, right? And these are, again, I believe all Warren Buffett companies. Now, the RLT favorite, Apple, still squeaking out some gains regardless of COVID. They're still growing. Maybe not necessarily as fast as previous quarters, but they're still growing. Am I saying that I don't like Apple as a long-term investment? So here's a question, guys. What are the odds? Let's think about this for a minute. What are the odds that Apple is going to quadruple in the next 5 years? Or actually, let's just say they're going to double in the next 2.5 years, or Shopify will double in the next 2.5 years. Which one do you think is more likely? Now, so Shopify, why Shopify, guys? Why not Apple? Apple's a favorite. Well, a few things. A few things. So first thing is Apple has made a massive run. If you're going to look at a chart of Apple, it looks something like this. It's already made a massive run, and it's been around for as long as I can remember. I don't know, was it started in the 80s maybe? I think it went public mid 80s, something like that, right? So The other thing I like is the other thing I'm not crazy about is Apple's gross margin. Now, if you think about gross margin is a 0 to 100%, which means if I sell something for $1, in this case, it's saying that I have a 38% margin, which means if I sell something for $1, I earn 38 cents gross margin, which means if I'm taking an Apple computer and I'm selling it for $100, it's saying that it costs $62 to make, and I'm $38 of profit. $100 revenue, $62 of cost, $38 of profit. Now, what does that mean? That means all my salaries, all my R&D, there's a lot of costs that still have to be paid after that 38%. Now, if you guys want to see, I can roll back a chart and we can take a look at what used to be, Shopify. Now, Apple, we just saw their margins. Look at the margins here, guys. Much, much bigger, with the exception of Square, which is credit card processing. But again, guys, you can see the margins, the gross margins are very high. So when I was a teenager a few years ago, just a couple, I read an article that the most profitable item, there's two things that are have very high margins. One is software, which is a lot of what we're looking at right here, right? Software. The other is perfume. So you think about $150 per bottle of perfume with $2 of chemicals, you got some nice high margins. So imagine combining these two things, right? Very high margins growing quickly. I mean, I remember trading Shopify when it was in the 20s and 40s. And had I sold my company and dumped all the money in Shopify and not looked at it for 5 years, it would be worth a nice penny, right? Coulda, woulda, shoulda. No one's going to cry for me, right? So this is a this is a FinViz screener, and this is kind of like this is kind of what we're looking at, and I'm just pointing out the sales growth quarter over quarter is kind of what we're sorting by here. Okay. So one thing that I can do also is I don't know if you guys have ever noticed this little auto refresh right here, but this auto refresh during the day, I'll click 3 minutes and I'll have it open on my monitor, and I'll just let it there. Every 3 minutes is going to refresh. And I'm going to keep up with, is the stock down? I'm going to look at it all at once and see, there's a column over here on the right that I didn't capture, but it's basically the change for the day, which means, is it up or down? And I'm going to be looking for that 4.5% pullback. Now, it doesn't automatically mean if I see it, I'm going to jump on it. Today, I had several, and I'll walk you through some of my current positions at the end of this. And that's kind of where we go. Now, someone asked, do I like, if I look at year over year too? I do a little bit. The problem is companies that haven't been public for 5 years don't necessarily have the data. So a lot of times it's newer companies, newer IPOs don't have a value there. It's blank. So Shopify for many years was blank until most recent year or two. Yep. Do I use short float to help make some trade decisions? I don't necessarily. No, I don't really. I do for other things, but not in this strategy. Yep. And again, guys, if we're comparing Shopify to Apple, if we're comparing them side by side, which one do you think will grow most likely? I'm going to bet on Shopify. Now, Shopify has already made a massive, massive run from the early $20 to $40 range. It's already made a massive run. But if you're growing quickly, like 97%, we'll just say you haven't seen nothing yet. You ain't seen nothing yet, right? It's going to keep going. Now, Fastly, which is down quite a bit. I know Fastly, I actually have some puts on Fastly that are currently right at or in the money. I'll show you guys here in just a second. Yep. Okay, so you guys understand the difference between cash generation. So I think of it in two buckets, which is basically what kind of company it is it's going to go in one of those two buckets. The third bucket that I'm not really talking about is a none of the above bucket. So for many years, guys, a company like Sears, so the old school retail company, which was the dominant retail player long time ago when my grandparents were parents, when they were much younger, long time ago, Sears was the dominant retail player even before Walmart, right? Sears was it. They were the junk. They were out there, and they were at some point either generating cash or growing quickly. I think they came off the stock market maybe 2 or 3 years ago, but I would put them in a none of the above bucket. They weren't generating cash, they were losing money, and they weren't growing, right? So if you think about it, if a company is growing quickly, everyone's kind of critical about, hey, they're not profitable. Shopify's not profitable, or whatever company's not profitable. But think about this for a minute, guys. Let's say you make $100 million of profit in your company, your public company, $100 million. Are you going to pay that out in a dividend, or are you going to throw that on the fire to grow that growth fire? You're going to land and expand. That's the strategy. You're going to grab as many customers as you can, you spend as much as marketing. It's a choice that they make to take all their profits and grow aggressively, right? Beg, borrow, and steal as much money as possible to grow their revenue. And at some point, they'll relax their marketing a little bit, and they'll become cash. Then they'll become cash generation. They'll slow down their growth a little bit, right? It is very much it's a choice they make. So as CEO of a software as a service company, it was a choice we made. We chose to spend, $50,000 a month or whatever on marketing. It's a choice we made. Well, whether or not you had the money or not, it made sense to do that. We saw the statistics and analytics, and it made sense to do that. Okay, so here's one other question for you guys. How much of this information will we know ahead of time? Right, so before the market opens, we have our watch list, right? We have our strike price figured out. We know whether or not we're going to look at whether or not we want to sell 1, 2, 3, 4, 5 months, right? We're obviously going to sell to open. I can show you how to calculate the size here in just a second. And then we know that we're going to be working with puts, and we know we have our 1%, right? So pretty much all of this we know ahead of time. So if we know all this ahead of time, does this make life easy for you? You don't really have to make lots of decisions, right? So JS, the outside of market hours, you're right, is not reliable premium, but you do know the minimum you want, right? So if the bid ask is $3 and $3.50 and you're looking for $5, you can absolutely put out an order for $5. You may or may not be filled on it, but you can certainly do that. And that kind of implies that the price will come down a little bit more as well, right? Okay. Okay, so how many contracts do you sell? So there's 2 ways to do it. When I first started out, I was super, super aggressive. And I would say, I want to collect X number of dollars of premium. And I would do the math. How many contracts do I need to sell? And this is kind of the aggressive approach right here. This is very aggressive. So imagine you take 3R and you say, I want to collect 3R premium. Okay. And that's one way to do it. Another way would be spend based. So the way I do it now is I'll say, I want to own X dollar amount of these shares. And I do the math between how much money I'm collecting, what the strike price is. And let's say, for example, I want to own $20,000 or $10,000 worth of the stock. I may only sell 1 contract, which means when it's put to me, I'm spending $10,000. I'm spending $20,000, whatever predetermined amount there is. So there's 2 different ways to do that. We're going to walk through some examples here in just a second, and I'll get a volunteer. And in our example, we'll just start with 1 contract, and we'll kind of walk through how that works. So Doug is correct. We do know what the premium is, the minimum premium that we need, right? We can, if we're looking for $5, if we're looking for $5 and it's currently $8, yes, absolutely. We have a choice. We can sell a lower strike price to still get that $5, or we can go ahead and sell it for $8 and get more than we need, right? Or more than our minimum, right? Yep. So how do I determine how far out I want to go? So what I like to do is I like to stagger it. I have currently let me take a look at what's on my list currently, but I have several, let's see, what do I have right now? I have 1 November 20 and 2 in December and 1 in January. So that's what I have right now. I don't have a lot out there. I'm 75% cash right now, which, as you guys know, going into the election is probably a good thing, right? So how did I come up with 1%? What is your guideline to arrive at this 1%? So 1% is a healthy amount to make based on the risk you want to take. So the way I like to do it is I like to think about it in terms of what is, if I do this on a monthly basis, if I sell 3 months, I'm going to get 3%. And I typically don't use my whole account. I do combine put sales with a few other strategies that I use and kind of collectively do things, but I like at a minimum a 1% rule, and that's a similar number that Jeremy uses for his premium as well. Questions? Okay, John, great question. I like 1% of the current stock price. We'll get into the charts here in just a second. I'll show you. Okay. Any other questions? You guys ready for a live review? You guys want to take a test drive? Do you feel like you have a good solid foundation before we jump into the deep end here and look at how this is going to play out on a chart? You guys have any questions? You ready to go? Okay, excellent. Let's jump into it. One sec. Let's switch over to my chart and maximize. Yes, I do have a lot of icons on my desktop. Okay, so let's just go back at any point in time. In this case, we're looking at Fastly. Okay, so Fastly did an IPO May 17th. So they've only been, wow, that's surprising. They've only been out a little over a year and a half, something like that. Okay, so let's go back in time. You guys will see that our red line is starting here. Now, what is the significance of the red line on this? In my indicator, the red line represents the 200-day simple moving average. Now, why does the red line not go to the left? What do you guys think? Screen semi-blurry. Can you guys see my screen? It's blurry. Let me try to share 1 sec. Let me try to share it a slightly different way. Let me share the window itself, not the full screen. Okay, what about now, guys? Can you see my screen? Is that better? No, it's not better. I wonder why it's blurry. If I make it smaller, is that any better? I mean, you guys can zoom in. Resolution. Let's pause for just 1 moment. Let me see. Does anyone know what that setting is? I'm not that familiar with the settings here. Let me uncheck a screen and let's try that again. Is that any better, guys? Oh, okay. So I had to uncheck. I had to uncheck that box. What about now? Better? Still good? Guys, thanks for bringing that up. We could have got this squared away earlier. No worries. All right. You guys with me? We need to take a break. Okay. So again, we're looking at Fastly. I got my indicator turned on, which is my little green areas. Now, someone tell me why the red line just starts right here. Tell me why. So because it's a new company, we don't have 200 days of moving. We don't have 200 days of average. So right here, we have 200 days to build our 200-day moving average, right? So what we're looking for, guys, is we are looking for let's look for a dollar sign and let's wait to pull back into the green zone, correct? Okay, again, we get the dollar sign. It just barely kissed the top line. We didn't really, we had to be super fast on that. Didn't really make it that day. Let's see what happens. Again, we're looking for a pullback into that area. Again, going higher. Now you'll notice that we do get some green dollar signs, but they're not in that area that we're looking for. They're not kind of inside of that shaded area, like our sell zone or our zone that we need to hit to get maximum premium. Obviously on this day right here, we do get the green dollar sign, but guess what? We're at all-time highs in that same day, right? So the fear factor is not going to be high. It's like, I don't even want to take my sunglasses off to look at my phone, right? To look at my account, because I'm on the beach enjoying life. We were at all-time highs just a couple hours ago, right? The dollar sign needs to be in the green or the candle. I'm not sure what that means. So the green dollar sign. I think what you're saying is the green dollar sign is just below the candle, but we want the candle to come down into this area, something like this. World's best looking candle ever, right? So let's roll forward. Boom. Does that meet our criteria, ladies and gentlemen? Yes or no? At least to check the premium. That meets our criteria to check the premium. Now let's pretend we are here in May 26th, right? So we're here at May 26th. And let me get a volunteer in just a second. Let's go in here and let's take a look at how some of this works. Let me see if I have a volunteer here that I can pick out of the crowd. Let me see. Does anyone want to be a volunteer? Let's pick Xochi. Xochi, you were there. Can you hear us?
Yes, I can hear you.
Xochi,
Hi.
you're familiar. How are you?
Great, thank you. Hi, everybody.
You're familiar with the naked put strategy, correct?
Yes, I learned it at the retreat.
Yes, so you're still learning, you're still growing. I'm still learning myself. So Xochi, does this meet our criteria?
Yes.
For selling a put? Now, if we are sitting here, let's say at the end of May, what month do we want to sell? Do we want to sell out 1 month? Do we want to sell out 2 months? Do we want to sell out 3 months? How far into the future should we go?
How about 2 months?
2 months. Okay. So guys, ladies and gentlemen, our current price is what? $39.31. So in this case, how much premium would we need to collect? If it's at 39, so it'd be 39.31 times 1%. I'm sorry, times 2%, correct? Times 0.02. And those of you with a calculator can quickly say it's 78 cents. Is that correct?
Correct.
Okay, so in this case, guys, what does the 78 cents represent? That represents our minimum premium, right? And so Xochi, if you can follow the line here, what would our strike price be?
$33.
$33. Now, Fastly may or may not actually have $33. They may, but let's pretend that it's maybe a 30, maybe they have a 25 and a 30. But in this case, we're going back into June. I'm sorry, I misspoke. We're going back, we're at the end of May and we're selling into we're selling into August, right? You wanted 2 months, so June,
yes.
To July to August. So we're right here. This would be 1 month. This would be 2 months, correct? So correct. We want 78% premium. And what are the other pieces of information, guys, that we would need to set up an order? So we know what our minimum premium is. We're going to check here in just a second. What else do we need to know? We're looking at the August expiration. What else, Xochi? Our strike price.
Our strike price is $33.
33 strike. What else? We're going to buy to open or sell to open?
We're going to sell to open.
Sell to open. Now, is that correct, ladies and gentlemen? Sell to open, correct? Yes. In this case example, we're going to do one contract and then I'll show you a little bit more how to do it. Okay. What else? We need to know the ticker symbol. That's helpful when we get into looking at our brokerage account. What else?
It's above the 200.
Yep. So that checks our box. We're also going to be selling put options, right? So we're going to be looking at the put option chain. What else?
Okay.
Is that it?
Premium.
Or premium? We said we needed 78 cents premium. Okay. Anything else, guys, that you can think of? The number of contracts. In this case, we'll just say one. We'll say one contract just for ease of math. Easily. So for 100 contracts, Xochitl, how much premium would we collect on one contract? 78 cents.
So we should be collecting $7.80.
So we'd move the decimal twice to the right.
$78.
$78. That's right. So guys, how much? No one's going to get rich off $78, right? But we obviously can add a 0 to this, and we would collect 780 if we sold 10 contracts. So at this point, Xochitl, what would our actual cost basis be if we did collect 78 cents, $33 strike? What would our cost basis be on a per share?
So that would be the strike price minus the 78 and the 7.8. So 25.20.
So we got $33 and we're subtracting 78 cents. So this is on a per share basis. So
Okay.
it would be, I believe, 32.22. Is that right, guys? Yep.
Yes.
Okay. So that would be our cost basis. So what would happen, ladies and gentlemen, if we bought I'm sorry, not bought, but if we were exercised at our $33, our actual cost basis would be $32.20, right?
Correct.
32.22, and we'll say cost basis. So imagine, ladies and gentlemen, that you're kind of buying 20. So the green line again, 25% below the high. So Xochitl, which candle would do you think is the highest close? Not the highest high, but the close. Which candle? Which of these candles?
The highest close May 21st.
May 21st. So this candle.
Yes.
Yep. So this candle right here is the highest close. The next candle closes down here. Obviously, this one closes here, right? So we have kind of all this information that we need. And typically what I'll do is I'll just either scribble it down on paper, or I'll use like a spreadsheet to calculate this information. And let's jump into I need to switch screens real quick, but let's jump into and check our actual premium. Now, how many of you guys put a TOS in the chat pane if you use Thinkorswim? I'm going to show you something you may not have known. Put a TOS in there. Edward, wouldn't you know the fear factor? The fear factor is not that high. It's not that high. Now we have the ability to sell it here. Xochitl, do you want to sell? I should have asked you that at the beginning. I'm sorry. Do you want to sell it here, or do you want to wait a candle or two? I probably should have.
Then we can keep moving. Yeah, let's go ahead and sell it.
Okay, let's go ahead and sell it. Okay. Let me pause screen share for just a moment. Let me switch to my Thinkorswim window. And let's share again. I need to share Thinkorswim. All right. Can you guys see my Thinkorswim? Oops, you cannot. What about now? You should be able to see.
Yes,
okay.
We can see.
Okay, so there's this feature in Thinkorswim called On Demand. You guys may have known about it, may not have known about it. But I am able to go back and pick a date and time and go back. In our case, we were looking at the August. Oops. Click. So we're going to go back. We were at the end of May, correct? I'm
May
sorry.
26th.
Yep, May 26th. No, it couldn't have been May 26th. It was, what was the date? So Zara, the 33 strike was represented the 24th. Okay, there we go. May 24th. And I'm in Central Time Zone, so let's just say 14:59, kind of a minute before the market closed. Let's take a look. Let's go back in time. How many of you guys didn't know you can do this, but you actually use the on-demand feature, go back in time, and let's look at the actual option chain. Let's look at how much it actually cost. Let's sell it, and let's roll forward in time. We'll look at 2019. Yes, that's correct. No, I'm sorry. No wonder it didn't load. I'm in the wrong year, right? 2020. Yes, apologize. May 2020 on the 20, couldn't have been the 24th then.
I had the 26 written down.
26. There we go. Thank you, Zochi. Keep me on track. There we go. Okay, so let's pretend that it was May 26th and we're just 1 minute before the end of the close. And obviously this is kind of a pre-market, I'm sorry, an intraday strategy where you can sell these in the middle of the day. And you'll see here that, let's see, how do I show the balance in this? Oh, well, we'll come back to it. Okay, so we're going to sell. What are we going to sell? The July, what we said?
Yes, but August.
Sorry?
August.
August, sorry, August. There's no August. Well, there's there's July and September. Okay, so we won't be selling August. What do you want to sell, July or September, Zoji?
September.
September. It says right click on the asterisk. I'm right clicking on the asterisk. Okay, we'll come back to it. Okay, so in our case, we actually have a 33. Okay, so let's kind of rethink this since we don't have an August option. We need a minimum premium of, what was our minimum per month? It was, remember? Our minimum premium per month was
78 cents.
8 cents. That was for 2 months, correct?
2 months, correct.
Okay, so if we need, let's see, we're going to go from May, we're going to go to June, July, August, September. We need 3 months. So we need 3%, right? So guys, at this point, what we wanted to sell was not available as an option. So what we're going to do is we're going to collect some more premium, right? So I calculate about $1.17 for 3%. Is that right? I'm going to double check that. May not be right. It was,
is it 99 cents?
it was 39. So $1.17, right? It's 39 cents times 3. You guys all see how we calculate that? 39 cents times 3. What we're looking for is a minimum of, yep, okay. So again, the stock price was around $36, right? We're looking at the, let's say $36. And we're saying times 0.03 equals $1.17. So that's kind of what we're looking for our minimum. Okay. And again, our strike price was what, Zochi?
$33.
$33. Now, again, guys, just a little bit of confusion there. $36 is where the current strike price is. We're going to sell a $33 put. So let's do it. Let's see what happens. $33. Okay. And you can see the current bid ask spread here. It's here. It's 4 and 430. Obviously a mid-range, mid-range is about 415, right? So let's sell one contract. And this is exactly how it would be set up. If you're using Thinkorswim, this is the exact way you would set it up. You would say, I want to sell one put. I would do the 18th of September, which is the normal monthly option. Not all stocks offer a weekly option, $33 strike put, right? And in our case, we're going to sell it for $415. You want to sell one contract or more, Zochi? You want to go get a little crazy?
Sure. If it's a virtual account, we could sell 10.
Okay, 10, ladies and gentlemen. Going crazy. So we'll do 10. Okay. Now, does this look correct to you guys? Does this follow our rules? Does the chart look right? Are we following our plan? Yes or no? Edward Yes, so that's a great question. I do check earnings in this case, just as a quick example. Earnings, at least on our chart, is not defined at that point. There's no earnings $sign that was on the chart. Yep. Okay. Earnings is 8.8. Well, in this case, we're going to be selling over earnings. So ladies and gentlemen, do you get more or less premium when you sell put options over earnings? More or less. Why is it more? Why does it matter?
More volatility.
There's like an unknown future event that could be really good or could be really bad, right? Now, if the stock gaps down to 20, then you're going to have, like you're going to have a red P&L, right? And if earnings were in, what did you say, Edward, the 8th? I'm sorry, Edward. So we're looking at 2020. You were talking about 2019. Yep. Okay, so let's go ahead and send it. Does everything look correct, Xochi?
Yes.
Everything look good? We're going to send it. Okay, boom. So you heard that famous noise inside Thinkorswim. We are short 10 contracts for put options, right? So our average price, $4.15. Does that sound good? Okay. So if I was to look at the chart and I was to roll a couple more, let's go back into our example. Can you guys, you can't see my screen. I need to go back to my other share. 1 second. Share my desktop. Okay, you guys see my chart still?
We see toss.
Resume share. Let me try again. Desktop 1. Share. Okay, you still see, you probably see my desktop now, right?
Correct.
Well, let's see, where did my Fastly go? There we go. Now you see Fastly, yes?
Yes.
Okay, so ladies and gentlemen, what did we do? We sold our $33 strike. We collected how much premium, do you remember?
$4.15.
Which was far above our minimum, right? $4.15. Oh, that's terrible. That is terrible. Let me try again. $0.15. So at this point, our cost basis is actually lower, correct? What is our actual cost basis? If I take 33 minus 415 is, what is our cost basis?
28.85.
28.85. 28.85. So that is our actual cost basis because we collected $4.15. So ladies and gentlemen, at expiration, if we close below here, or actually our strike price, if we were to close in this area, would the trade be profitable? Yes or no? We would be put the shares, right? But the trade would still, Mariasha, why would it not be profitable? So our actual cost basis, so we'd be put to shares, right? The shares would be in our account. We got paid $4.15 to guarantee the $33 strike, and our cost basis would be $28.85. Yeah, okay, perfect. So I want to make sure you guys are with me. Okay, so if that is the case, let's roll forward a few days. Xochi, what do you say?
Yes, let's go.
Let's do it. So let's roll. Let's take a candle. Okay, right here. See what happens. Obviously, our P&L had a little bit of a lower move, and we made some lower low, correct?
Yeah.
Now, at this point, guys, let's roll over to Thinkorswim and let's take a look. Can someone check real quick on May 27th? What was the low, the time of day, the lowest low in Eastern time zone? What was the lowest low of May 27th for Fastly? And let's go into our Thinkorswim. May 27th. It's probably not the middle of the day. It's probably not the end of the day because we closed up. Let's take a look at what our chart would say. Okay, so does someone find the time? What are the chances that you actually put the shares above the cost base but below the strike price? It does happen. It does happen. Why someone want to do that? I don't know. I've seen some weird stuff. 11:05 Eastern, so that would be in my time zone. That'd be 10:05. Okay, so let's look worst case scenario at that low on that one candle on the current day. Let's take a look at what our P&L. You guys see the P&L over here? Yes, we're down $200 on the trade. We collected $4.15, and we how much total premium did we collect, Zochi? Do you remember? $4.15 times
$4.15.
So 10 contracts.
So that would be
$4.15 times 100 times 10.
$4,150.
$4,150. So we collected that in our account. Cash hit our account. We still have an open liability against that, right? Now, at the lowest low of the day, we're down $800. Now, how many of you guys would freak out if you saw a negative $800?
A little bit.
Now, yeah, it's unrealized, of course. Yep. Red's bad, sure. Do you guys think Warren Buffett, the greatest of all time, you think he has red days?
Yes.
No hair, don't care. Now with the strategy, nope. Yep. Okay, so we're down $800 at the lowest low of the day. But if we were to roll to the very end of the day, if we were to roll to 1 minute before the end of the day, that $800, we're going to pre-buffer. Let's see what the $800 looks like. Drum roll, please. Negative 800 becomes positive 250. Look at that, guys. If you didn't panic, you didn't pee your pants, you're up. That's a pretty good swing, right? Zochi, negative 800 to positive 250.
Yes, looking good.
So the difference between the lowest low and where we closed on the day, I would say that's pretty amazing, right?
Nice.
Which means if you follow your plan, things will be okay, right? Okay, so let's roll one more candle. Is the P&L going to be higher or lower than it was the previous day, Zochi?
Higher.
You guys can agree? Higher or lower? Higher, yep. What about the next day? Woo, look at how that closed. Shave top Marbozu. Look at that goodness. May 29th. Let's get into that. May 29th. Let's pre-buffer. Let's see what our 250 becomes. You want to take a wild guess? Soji, give me a guess before it loads. 250 will become how much?
1,500.
950. Boom. 950. So guys, you remember we were just 800, negative 800 like 2 or 3 days ago, and we took a swing back the other way, $950. Now my rule says you can buy it back at 50%. So if we sold it for 415, Zochi, what would 50% be? How much does it need to be in order to close it? Like a minimum amount to buy back. What's that?
We're going to buy to close.
Yep. And this would need to be half. Our average price is $4.15, and we would need to be half, correct?
Half of the 415?
Yep. That would be how we'd buy it back.
Okay.
Right? So that would be, let's say $2 and change, 205 and change.
Mm-hmm.
Okay.
Yeah.
So what would you like to do? Would you like to take the win, or would you like to keep going?
I probably would take the win and play it safe, since it would be the first one.
But our plan says 50. 50. We haven't quite hit our target.
We keep going.
Okay, so we're going to keep going.
That is our job, to execute the plan.
There we go. Absolutely. Sorry to throw you a curveball. So what about now, guys?
Yes.
Pretty good move.
Yes.
And again, guys, what this strategy is essentially saying is that whatever, we're just basically saying, hey, I don't think it'll come back down to this line. And if it does, I'll own it. That's basically what we're saying. Now, yeah, it could go all the way back down to, a company can file bankruptcy. A lot of things could happen, right? And right through here, you guys saw what happened with COVID. A lot of things could happen. But essentially what you're saying is, I think that the price will not go that low. And if it does, I want to own it, right? Again, guys, do not sell put options on companies you don't want to own. These are like firecrackers that blow up in your hand. Don't play with the fire. Okay, so let's check now June 1st, Xochitl. Let's take a look-see. Let's see where we are. June 1st. End of day. How much? Give me a guess. We went from 950. How much? We're going to be up. How much?
2,500.
Ooh, 1750. 1750. And what is the minimum we're looking for to buy to close?
$2.05.
2.5, 2.10. Yep. Okay. So we're not quite there. Let's roll forward one more day. Oh, barely anything. Look at that. It was a hard battle between the bears and the bulls. Look at that. Okay, let's roll forward one more. Oh my goodness. Can someone check the high of day? What was the high of day on June 3rd? Like, look at a 1 minute chart. Give me the time of day, please, in Eastern time zone. And we're going to roll to June 3rd. And we're going to see if we got our minimum so that we can buy to close. Yep. Yeah, 207. Most options are kind of trading 5-cent increments. So 207 is 205, 210, whichever. Yep. So I need a volunteer to check the intraday high. What was the high of the day on June 3rd? What time of day in Eastern time zone was Fastly? 50:49. That's not a time. What kind of clock you got over there, Lucian? I want the high of day. Yes, the high of day, not the dollar amount. The time of day. I'm sorry. Not that I misspoke. I want the time of day where we were at the high of day. Right. High of day. I apologize. That was my fault. The time at the high of day. Yeah. 12:40 in Eastern. Okay. So 12:40 Eastern would be 11:40 my time. So let's take a look. Xochitl, what are we looking for? What minimum premium?
205.
205. 205, 210. Ladies and gentlemen, let's take a look. Drum roll, what was our P&L going to say? Oh, still not quite there. 1675. Okay, so our plan says we keep going. Boom, we're P&L up or down a little bit from the previous day.
We're down.
Just a tad. Now, guys, when we're selling put option, is time decay in our favor or is it working against us? It's in our favor. So people ask me, Matt, why can't I just buy calls? You can, but the theta, you're on the wrong side of the time decay, right? It's not working in your favor. If you're buying call options, in this case, the stock could literally go sideways, right? The stock could go sideways and we would still be profitable, right? If a call option was out of the money and went sideways, you would lose your premium if you let it expire, right? Okay, so Xochitl, what are we gonna do? We're gonna go another candle, right?
Yes.
Oh, so we're down even more. Now, would you sell more or would you just hold on to your original position? Would you
I would
position?
hold on to the original.
Okay. What about now? Looking a little better, right? It did kind of make a new low there, kind of, but it quickly turned around.
Yes.
What is happening here? Look at that, another new low. Well, we closed lower. What about now? Looking a little better?
Looking better to keep going.
Now we sold the, what month did we sell? We sold
The September.
September 18th. Yep. Okay. So we still got a ways to go, guys. We got all the way out here to go. So a lot can happen, good or bad. Boom. What about that? You guys think that this would have been a good opportunity, like a new all-time high?
Yes.
Yeah, all-time high, right? So it closed near the high. So let's look at June 15th. Let's roll in here. Let's say, what would our P&L set on June 15th at? My time would be 14:59. What do you think P&L is going to say, Xochitl?
We should be able to get out now.
We'll see. Yep, Tracy. So we closed near the high, so I didn't necessarily jump into the time of day just for explanatory purposes. 2450. Oh, it's flirting with us. We're almost there, Xochitl. It's teasing us. 2450. Now, how many of you guys would like to have a $2,450 trade that you decide, hey, I can easily buy to close this or I can let this roll? How many of you guys have ever had How many of you guys have not say $2,500 win? Yep. Chris Stanley. Okay, now we won't say you have not, we'll say not yet, right? There's a difference, right? We're gonna expect good things, right? Okay, so not quite there, Xochi.
Yeah.
We're gonna roll forward. What about now?
Okay,
Oh,
time to get
all right,
out.
June 16th. Let's take a look. Let's roll back a little bit. Let's go to maybe 1400 on the 16th. So maybe an hour before close. All right, Xochi, you ready? Are we going to lock in this game? Are we going to take it or are we going to let it run?
I would say take it because it's already at all-time highs.
Yep, absolutely. Oh, barely moved. Look at that. Look at that. Barely moved. Is that right? Yeah, it loaded. So what I'm looking for up here, guys, is make sure the pre-buffering is completed. Okay, so we have no choice. Oh, what about now?
Nice, nice. Okay.
Let's take a look. June 17th, an hour before close. See our pre-buffering, guys? We're waiting for that to load and we will see 29. Oh, what about that? Does that meet our plan?
Yes.
115. Okay. So what are we going to do?
We're going to buy to close.
We're going to buy it back. And how many we're going to buy, Xochi?
10 contracts.
So we're going to, because why are we buying 10 contracts?
Because we sold 10 to open.
We sold to open, just like if you're shorting actual stock, you sell to open. In this case, we're buying to close, right? And what price should we pick here? $1.18 is kind of the mid price, the in between the bid and ask. Let's see. Where's our chain here? So, yep. So 110, 125. Good. 118 is right in the middle. You guys in Thinkorswim, you have this position, which kind of means you have an open position. We're going to buy to close, Xochi?
Yes.
Okay, now guys, I want everyone to imagine $2,975 entering your bank account right now. Okay, that's essentially what we just did. And we picked a random stock and we followed the plan. We executed the plan, right? We're going to close. Boom. Thank you very much.
Nice.
You guys, $2,975. Thank you, ladies and gentlemen. Thank you, Xochi. Thank you so much.
Thank you, Matt. Very interesting. Thank you.
Yes, ma'am. Okay, so yes, Xochi rocked it. So she did learn this strategy. We kind of talked through this at the retreat. And these strategies aren't hard. This is a little bit advanced. I know it sounds a little complicated, but I want to show you guys. Obviously, we bought to close, but what would have happened? Let's play the devil's advocate. What would have happened if what do we have? The September 18th, which would be right here, this time frame. What would have happened if we just held for that extra dollar and change? What would have happened? Let's take a look. I don't know. We'll see what happened. Ooh, it's getting up there. We want to see where it plays out. Let's just hit the play button. So again, guys, our cost basis down here, our strike price that we sold is $33 right here. We want it to cross this blue line, either at or above that strike price that we sold, right? See what happens. Okay, so if we let it expire, we could have captured that extra dollar. So in this case, because we sold 10 contracts, an extra $1,000 in change, right? Yep. Okay, so let's go back into our slides. Okay, guys, you've heard me say this before. As a trader, your job is not to buy and sell. It is what? What's the job? What is your job? It's your only job. No, manage risk is part of it, Patrick. Yep. Hopefully I got, you guys know where I'm going with this, is to execute your plan. Yep. So how many of you guys would like to have this exact strategy put in a PDF format? And we'll call it part of our recipe card collection. Yep. So we actually have this written out. It's in a recipe format. For those of you who know or familiar with cooking, you obviously have some ingredients you got to define ahead of time. You have some steps that you need to follow. And obviously any kind of recipe assumes that you have some basic knowledge, right? You know how to use a mixer, you know how to measure a tablespoon, you have something, so we don't define every little bitty thing. But if we're able to put that in front of you guys, how many of you guys would be interested in that? Okay. So if you are interested in that, go ahead and put in the real life trading chat pane, in the real life trading channel. Let's go ahead and put hashtag, hashtag put sales. If I get enough, if I get enough, I will go ahead and upload that for you guys. Oops, drawing everywhere. Okay, let's do it. I will upload that here in just a moment. Put sales, and Slackbot is fighting back. You guys, I use the pound put sales with no spaces. That will kind of slide under the Slackbot radar, right? Okay, so let's move along. Let's see. So most traders who are familiar with call options, time works against you. In our case, time works in our favor, right? So if I was to look at, I know it's a little bit confusing, but bear with me. If I was to go out 30 days, 60 days, 90 days, or 40 days, so represents 1 month, 2 months, 3 months, or 4 months. If I was to go out, as the time continues, right, as we kind of tick down towards our expiration date. So if we sold in this case, we sold a 4-month contract, as we move around, as long as the time decay, as long as we're out of the money, the time decay will work in our favor, right? The time decay will burn, which is the exact opposite when you're selling a put. It's the exact opposite of buying a call, where time decay kind of works against you, right? Guys, if you put pound put sale without put sale, or put sales plural without the space, otherwise you will awake and summon Slackbot to respond. If you do it without the space, you'll slide into the Slackbot radar. Yep. Okay, Ken, you had a question. You have raised your hand. You want to come on the mic, Ken? Maybe not. Okay, let's move along. Okay, so clear my drawings. All right, so what about expectations? What should you expect? So as the price approaches the strike price, your P&L will be red on the trade. Why is that? Actually, I have a perfect slide for that. So let's imagine that we sold a contract, and let's say in this case, we sold it for $3. Oops. And let's say that we sold a contract, we got $3 per share, $300 on the contract. And we sold it on this day right here. We sold at the kind of the close of the day, and we collected $300. Okay. Now we don't know what's going to happen in the future, correct? We don't really know what's going to happen, but let's say we sold one contract here. We collected $300. Now let's say the next day, Xochi steps forward and Xochi sells $500. She sells it for $5 per share, or $500 per contract. How much is my P&L going to be red if she sold it down here and I sold down here? Let's assume the exact same strike price, which is my green line. And let's assume the exact same expiration, $200. Now, why would it be $200? We both sold the same thing. Well, it's one of the weird things that happens in when you're trading and selling put options, is because someone sold it for more, that means the market value is higher than what I sold it for. So I'm going to be negative $200. I'm going to be negative $2 per share. Now, let's say that I have 12 contracts. 12. What is my P&L if I sell 12 contracts up here, what's my P&L going to look like? So it's going to be, I'm going to be down $2 a share times 1,200, which would be $2,400. That's right. So again, guys, when we're selling something, we want to get as much premium as possible, right? And so let's say we roll the next day. I sold at 300. Xochi sold it at, I'm sorry, I sold at 300. Xochi sold it at 500. We're going to roll forward one more day, right? And then let's say that Steven sells it for 850 down here. What is my 12 contracts? What is this here going to be? If I sold it up here, what is it going to be down here? Well, it's going to be really red. Yep. It's going to be really red. It's going to be the difference. 850 minus 300 is 550 or $5.50 times 550 times 1,200, right? Is that right? Yep. So the difference between 850. So I collected 300, Xochi collected 500, and I collected 850. So it'd be 550 times, now why is it times 1,200? I'm sorry, 550 times 12. Why is it 1,200? It's because I sold 12 contracts, right? So 1,200 times 550 is negative 6,600. Now, how many of you guys can stomach a unrealized $6,600 unrealized on your P&L? How many of you guys can stomach that? Too much for me. We still above the strike. Yes, our strike is down here, this green line, right? Yep. So whatever the strike is still down here. We're still above it, right? So what does that mean? That means we're still out of the money. It's not going to be put to us. It's just someone else got more than we did. Now imagine selling a classic, I don't know, 1967 Chevy Camaro, and you sell it for 30,000, and your neighbor has the exact same one. He sells his for 35,000. Does that really mean you lost the difference? Did you lose the difference between 35,000 and 30? Did you lose 5,000? No, that's just how the P&L works though. So you need to make sure that you understand this when you're selling puts. Now I down here would be, I'd be down 6,600. Now, how much would Xochi be down? She'd be down the difference between these two numbers. She would be down how much? Xochi, how much would you be down? You'd be down, the difference is 350. And let's say you sold 3 contracts. So 350 times 300 equals 1,000, negative $1,500. So all this, guys, to illustrate is that don't be in a hurry to quickly sell it, because there's always tomorrow, and the market is always going to be open another day, right? It's always going to be available to us to sell more. We don't really know what the future holds, right? So in this case, JS, you wouldn't buy, you would actually sell a contract, right? Yep. So any questions about this? All this is, I'm trying to make sure you understand the P&L impact. When I first did this, it was very concerning to me because I was like, what did I enter? Did I enter the order wrong? Again, if the premium, I'm sorry, that I collect is lower than the next day's premium, and then again, we roll down to more premium. Obviously, I would have loved to collect $850. And so how do you mitigate that? How do you work around that? Well, let's say that I want a total of 12 contracts. And let's say I sell 4 here, 4 here, and 4 down here, right? That's one way to do it. I don't go jump in the very first candle that I get the go sign on, right? Same here and same here. Now, if our minimum premium was $300, obviously it meets the minimum rules. Obviously, I'd love to get 500. And if I didn't get in there, I'd love to get $8.50 or $850 per contract, right? And again, yes, the great point is you really have to be willing to own the stock. This is an advanced strategy. You can really blow yourself up. Now, some of you may notice in the Slack channel, you may notice that the Slack channel. So some of you may know that in this case, you're playing with fire, and when you see people post that you're not playing with fire, it is a little bit of a dangerous thing. If you're not careful, you don't know what you're doing, right? Just like any risk. the biggest risk you can take is the one you don't realize you're taking. So just all that to say, guys, don't sell puts on anything you're not willing to own, regardless of where the price goes. If you're like willing to own it here at, let's say this strike price is $400, don't say I only want to own it if it's at 400, because if it goes to zero, you still own it. You're on the hook for $400, right? So again, something to keep in mind, the risk piece of this, okay? The other thing is you got to absolutely make sure you have enough money in your account in order to do this. Now, if you have a margin account, you can literally sell, let's say you have a $100,000 account, you can literally sell $300,000, $400,000, $500,000 of liability against a $100,000 account. Now, does anyone see a problem with that if things move against you? Yep. So the problem is your kind of your liability is bigger than how much money you have. So imagine insuring a house for a dollar amount that exceeds the assets or the cash you have on hand. That would be a careless risk. It would not be a calculated risk, it would be a careless risk, right? If you did that. Now, sometimes you can use full margin on certain things. It is a double-edged sword, as you guys know. It can work in your favor and it can obviously work against you. Now, someone said, do you leave a buy to close order open at 50% value or less in case it hits? I typically don't. I typically will scale out. So if I have 4 contracts, I might sell 2 at the 50% and I might keep 2. Depends on how much time's left. And I've started letting things expire a little bit more. Obviously, if I sold a 4-month option contract and let's say a month into it, 75% of the premium is gone, I'm probably going to just close that out because it's not worth the extra 3 months of risk to make the extra little bitty 25%. So I would probably close that out. Yep. Let's see. In the past, I've rolled my puts down. So Jeremy and I don't typically roll puts because you're really rolling any options. You're essentially closing the trade and opening a new one. And most people roll puts if it's a losing trade. So you kind of kick the can down the road. Sometimes that works, sometimes doesn't. I don't typically do that. Patrick asks, do you usually close when you collect a certain percent amount or premium? Do you monitor it to squeeze last cent? Yep, just answer that. You could cover your put if it crosses your strike, or do you use another risk mitigation strategy? Great question. I will answer that in just a second. Now, do you make sure you have enough to cover all short puts for expiration? Yes, I think that is the smart, safe way to do it, is think about how much money you have kind of tied up, how much money you kind of sold against premium against the liability piece. Yep, absolutely. Ken, do you consider selling a lower strike than 25% for less premium? Yes, I do. I typically like to get my, that's what Thomas is doing here. What he's saying is I typically like to get at least my minimum premium. But if I have a choice between a lower strike or more time, I typically would go with the lower strike, right? So if I can get my minimum premium or more at the strike, I'll typically try to sell a lower strike put, which kind of reduces the probability in a way that it would hit my strike price, right? Okay, let's talk about some expectations so you guys can understand how this plays out. And we'll wrap up. It's getting late. Okay, so let's go to expectations. So I mentioned this and we kind of talked through this. We looked at this with Xochitl's example. As price approaches the strike price, your P&L on trade will be red. Don't panic. So 99% of the time, puts will expire worthless if you follow the strategy. Again, if one of 2 outcomes can occur, I'll show you that here in actually several outcomes can occur. I'll show you that here in just a second. Your entry price, sorry, my remote is acting up. Entry price is lower than strike. My strike price minus my premium collected, right? So our cost basis, so to speak, is lower than the actual strike price. So this is how you can adjust the trade. I do any and all of these. You do have to be careful here. You do have to be careful here if you are adding, if you're selling lower strike puts to improve your cost basis, because you are adding to a loser, right? And that's never a good idea. Imagine having hundreds of contracts of liability open, and it's October 2018. Do you guys remember what happened in October 2018? Yep. So October 2018, I actually had, I think it was 150 contracts open. This is when I was super, super aggressive. And it bit me. I had two 15R, negative 15R months in a row. And it kind of punched me in the stomach, right? And at the end of the day, what you learn is you have to respect the risk of what you're doing here. You have an open liability against your trades. And it's like two legs or two different pieces, two components of this strategy. So one thing I can do if it's like a market, the market itself is having like a pullback, again, don't sell at all-time highs. But one thing you can do is you can add a hedge position. You can do something like buy SPXS or UVXY, which are inverse ETFs. So they go up when the market goes down. You can sell kind of a lower strike price put. So let's say you sold, in our example with Xochitl, we sold the 33 on Fastly. We could have sold the 30 or the 27 or some lower strike price. We do have to be careful with that when we're adding to a loser. But let's say, like in Xochitl's case, we had 10 contracts. Let's say we wanted to do 5, right? We started with 5. We ultimately wanted 10, so we sold 5. And then the price moved lower, and we sold another 5. Now, in that case, that was part of our plan. We added to a loser, but that was part of our plan. We wanted to capture more premium on a lower move. Now, the other thing is we can also adjust the trade, right? So we can buy a lower strike put, same expiration, and then convert I said naked put, but put sale to a bull put spread. So you essentially, in the insurance world, you buy reinsurance. So a lot of you may not know, but a lot of insurance companies spend big dollars to think of it like buying their own insurance against a lower move. So they're selling insurance at this level, and they're buying a lower strike price below them, right? Okay, so that's one other thing you can do, and you convert a put sale to a bull put spread. And you can also, in the same account, assuming it's a margin account, you can also short the shares of the underlying stock as well. Yes, I will share the slides with you guys if you want. Yep. Okay, so what else? What else? Here's your possible outcomes. So again, things can go sideways, we win. Things can go lower a little bit, we win. Things can go higher and we can win, or things go a lot lower and we're put to share. So here's our possible outcomes. We can buy to close, 50% premium. In our example with Xochitl, we were looking for, what was our premium? We were looking for $2.05. So we can, once 50%, we sold it for $4.15. Once our premium has declined, we can buy it back. And again, guys, when we're selling, we want top dollar and we want to buy it back lower. We want to sell as high as possible and buy back low as possible. Just like in actual shorting of actual shares, right? You want to wait for the price to be high. You sell it stock short at $15 and you want to buy it back at $5. Or in this case, we're doing 50%. We want to short at 10 and buy back at 5. We want to short it at 4 and buy it back at 2, right? And so this is a possible outcome. That is a win. Now, what if we want to, what if the premium, let's say we didn't put our order in for 50% and let's say we're on vacation, we're elsewhere, we got 80% of our premium has declined, right? So we can buy to close 80%. So let's say we missed the 50% and it just rocketed lower. Like in our example, it went from, I think it was like $2.80 and then it just popped down to $1 and change, right? So the other thing that can happen is it could just expire worthless. So if we're really close to our expiration and it's out of the money or really far out of the money, we could just let it, we could do nothing and just let it expire worthless. I have done that very often as well. Or the fourth option, which is a good and bad thing, is it could expire in the money. And again, we're talking about put options. It could expire in the money. you have a obligation to buy the share. You do not have a right. The put buyer, the put option buyer has the right or the option, not the obligation, to put the shares to you. You have a right. You're forced to buy them. So make sure you know what you're doing. So at the beginning of this, you guys remember I said you have to have special option permission. This is kind of where the danger comes in a little bit. You need to just be aware of it. It's not super dangerous. If you guys want to play with this, I highly recommend you back test this, you back trade this, you know what you're doing. If you want to do coaching calls for me to kind of walk you through it more, we certainly can talk about that. But at the end of the day, this is if the shares are put to you, if it's in the money, the put option buyer has a right to put the shares to you. You have no rights. You are required to provide the insurance, the liability that you have. So again, but it does represent a 25% pullback, right? If that strike price, you're 25% pullback. So the best time to convert to a bull put spread, I don't do that a lot, but that's the best time to do that is on an up day, Tracy. So if you have a strong move lower and you get some kind of a bounce, this would be the best time to buy a lower strike. So let's say your strike is here and you want to buy a lower strike here. That would be the best time. Obviously right here at the low of this would not be the best time to buy premium. You'd want some kind of a bounce or an up day. Yep, that's the best time to buy a lower strike and convert lower strike put and convert it to a bull put spread. Yep, I don't do that a lot. The other thing is you now own, like worst case scenario, you own the shares. I have some Fastly shares that I sold. Let's see, what are they? Are $70, and they are right at or near the money right now. I didn't check how it closed, but we'll just say it's near the money. Now I did sell them for $3 and my actual cost basis is 67, $70 strike minus $3. My cost base is $67. But at the end of the day, I sold the normal November option. So at the end of the day, I will own a company that's growing 30% and has had a 25% pullback. Not the end of the world. I'm not gonna cry myself to sleep, right? ITM put strike price minus a penny, right? Not strike price. Not sure what that means. Yep. Do I sell naked most of the time? Depends on which account I have. If I'm placing a trade in like a long-term retirement account, I honestly don't really check it that much. If it's a margin cash account, then I am more careful than I was in previous years where I had 2 negative 15R months back to back and kind of lost my mojo there for a little bit. Yep. So as far as selling naked, it's the most dangerous and aggressive way to do it, where you end up having open liabilities that far exceed. I'm not talking about just a little bit, but multiples. So if you have a $100,000 account and you have 500,000 of open liability, you guys, if things move against you in a big way, then you can really get yourself in a pinch, and those capital calls can come knocking on your door. Yep. So naked calls have unlimited liability technically. It's kind of obviously the lowest the stock could go to is 0. Can't really go below that. So it is a calculated risk. So if you think about, are you willing to take let's say a $20,000 risk to make, I don't know, $400, right? So if the stock went to 0, now a lot of these stocks are growing quickly, and unless there's some outright fraud like LK, you guys remember Luckin Coffee, was it earlier this year? Massive fraud. Obviously, if you're playing these companies, that's a possible outcome. Is there could be some fraud. It doesn't necessarily have to be super. It doesn't necessarily have to be fraud to go lower, right? It could be lowered expectations. So Fastly lost their biggest customer, which was TikTok, and it happens, right? Am I holding off on selling puts until after the election? Mel, I am barely tipping my toe in. I'm selling a few contracts, 1 or 2. I believe right now I have 14 open contracts on 4 different positions. So very, very lightweight for me. Like I said, I've literally had hundreds of open contracts before, and I'm only at 14 now. So very, very lightweight. As far as the elections go, guys, I share the same thought that Jeremy has, which is even after the election is, which comes here in a few days, like I think it's Tuesday, November 2nd or 3rd, whatever Tuesday is. I think that we're still going to chop around for a few weeks after, because whatever political party you prefer, whether it's Joe Biden, whether it's Trump, this is not a political statement, but either way, whichever party loses, they're probably going to contest it, right? Like, oh, let's make sure, you know, that it was a legit election, make sure that there's integrity, the mail-in ballots, all that stuff. And I'm not telling you who to vote for one way or another. But all that to say that whoever the losing party is, there's going to be they'll probably contest the election, which could drag on for a few weeks. So I don't think that November is necessarily going to be smooth sailing. I think it's still going to be choppy. Yep. So just something to keep in mind, right? It's like if you're out on a sailboat, you're going to, if the weather turns on you, you kind of have to put on certain, you have to go through certain things. If you can get back to the harbor, get back to the marina, then fine. But if you're way out there and there's no way you're gonna get back to the marina, you just have to, be mindful that you're in choppy waters, right? Yep. Okay. So would you say, this 15 income is almost inside out, technical fundamental moat? I would not say inside out. There's always something. I do know the companies well. Yep. Do you sell puts always on the green line, or you go below it? So I do both, depending on how much premium I have. So yep, absolutely. You guys want to look back at some more examples? Let me see. Let me show you guys one more thing actually real quick. So here's a real risk, guys, if you think about it. I highly recommend, again, you guys back trade this, you paper trade this, you go back in time and play with this so you understand how it works. The biggest risk you can take is the one you don't realize you're taking. If you're like, oh, I made 2R on this one trade, isn't it amazing? But you had this big open liability, right? And it's unrealized, and there's some big move against you. That nice R win that you thought you had, it can easily turn against you very, very easily. Now, my very first trade, naked puts that moved against me, was NVIDIA. If you look at NVIDIA now, it's $400 or $500. I almost had a heart attack because I was up like $1,800 on this trade. And I panicked and I bought the close. And I think it was like a 2 or 3R loss. But worst case scenario, guys, if you look at NVIDIA, getting put shares at $100 is not really that bad of a thing if you look at where it is now. It was not the end of the world. But again, I didn't quite realize the big move against me. Someone else sold it for higher, so it showed a big red number, and I didn't quite fully understand this. Again, I didn't back trade this. I didn't when I first started. So I learned the hard way. So here's what some of these risks are if you think about how much kind of what could happen. So if you're put to shares, you need to ensure you have the capital to buy the shares. We've talked about put sales, and there's cash secured and there's naked puts. You technically don't have the cash to buy the shares, which is why they call it naked. Number 2 is your buying power is affected only about 10% of what you think. So if you have a $50,000 liability, your actual buying power will not go down 50,000. It might go down 5,000. And most brokers have a formula for how much buying power is affected. And it's not a calculator formula. It's like an Excel formula based on whether you're in the money, at the money, how much time is left, how many contracts you have, how much time's left till expiration. And so you literally can have a big liability against a small account, as long as it's a margin account. So just keep that in mind and be careful selling large amounts of contracts. I think the most I ever had in one thing was, I think it was Square. I had 45 contracts. No, so guys, 45 contracts. How many shares does 45 contracts represent? 4,500 shares. Now let's say that it moves $2 in a day. You guys can imagine how much your P&L will jump around if it moves $2 in your favor, $2 against you. You guys can do the math on that. Okay. Now, again, this doesn't really use the R system of risk because you do have kind of an open liability to be put shares. I will do one of two things. If trades move against me, I will buy a put which I did on Fastly. I bought a $80 put and I sold the $70. I did it in different stages, but I sold the $70 put, got $3. And then I bought an $80 put to kind of hedge against that. And my long puts that I purchased are green on the trade, of course. And my short puts, the puts I sold, are red at this moment. Yep. 9,000, right. So let's see. Let's pretend that you do get put to shares, right? Is it the end of the world? No, it's not. Well, what could you do? You could sell covered calls against your shares. Has anyone ever done that? Let's say you get put your 10 contracts to Fastly. If anyone sold Fastly or AOIX puts in the past week or two, you're probably going to be red on the trade like I am, right? It happens. I have put options, so it can go to zero, and I have two long puts at an $80 strike, and those are up more than I'm down on the actual short put. So not by a couple $100 difference, but I can sell covered calls against my shares, right? That's one way to kind of hedge against kind of lower moves. What else can I do? I could dump some shares. So if it's put to me on day one, I could sell those, exit those, and free up the capital. Now, a couple times this happened to me, 3 or 4 times, where the shares were put to me. The very next day it gaps up, right? So I collected the premium, and then I collected the gap up, kind of move in my favor, and then sold it. I can certainly do that. It depends on how much open positions you have, whether or not you want to free up some buying power, right? Open up capital for other sales, however you want to do that. And then of course, you always keep the dollar amount you sold. You always keep the premium, and you may or may not ever have the liability kind of put to you. You may or may not have a insurance claim, right? So that's kind of how that works. Okay, so you're 75% cash despite VIX being high. So high due to elections. Yes, Patrick, that's right. Part of why I'm 75% cash is I have a nice gain on the month and I don't want to give it back. So pretend, guys, I want everyone to close their eyes and pretend they're up 30.7 R. No reason to really be super aggressive, right? That's kind of where I am. I don't necessarily need to be super aggressive right now. I am selling. I'm very carefully selling some contracts. I have, like I said, I have about 14. Yep. And CrowdStrike, Datadog, Peloton, and Fastly. We can go look at those if you guys want to see. But that is kind of what I have now, and that's what I'm doing. There's no reason to be super aggressive right now for me because I'm up so much on the month. Now the world itself, I know there's a lot of drama in the US political system around COVID, and it's being politicized, and it'll magically go away after elections. I don't really think that's the case, obviously, because Germany, France, there's other countries that are affected that don't really have anything to do with the US government, and our US presidential election doesn't really have anything to do with it. So do politicians use things to their advantage? Absolutely, good or bad, right? Depends on which side you're on, but absolutely. Okay, here's a question for you guys. At what point am I losing on a trade? Let's say I sold my put at my green line. At what point am I losing on the trade? Well, if I sold this for, let's just say for easy math, for $8 on, I don't know, let's say this day, I sold let's just pretend that's 850, my 850 strike. Let's say that I got $8. What is my average cost basis? My average cost basis would be 850 minus 8, which would be what? 842. My cost basis would be $8.42. So unless I close below there at expiration, I haven't really lost. My P&L might be down because someone else may have got more money than I did, right? But again, that's really where I'm losing on the trade. So I like to think of these put sales. I like to think of them in terms of how far down, how far in the money am I or not, times the number of contracts. That's how I like to think about it in terms of whether I'm losing or not on a trade. Yep. When it gets below your dollar cost average, right? Your cost basis. Yep. Yep. Any other questions? I can show you guys some of my current trades if you guys want to see. Okay. We talked about this. Yep. So the other thing to think about, guys, is you only want to sell. Cannot stress this enough, guys. You only want to sell on stocks you want to own. Stocks you want to own. Don't go jumping into Tesla if you don't want to selling Tesla options because it's down today or down whatever day. Don't jump into it just because it's down. You need to be willing to own it, right? You need to have a nice, proper thought process where you're non-emotional, where you can sell something that is not, or it's not an emotional thing. I want to quick jump in and jump out, and I don't want to jump in front of the train and jump out of its way at the last minute. Don't do that. You only want to do these on things you want to own, right? The other thing is don't be in a hurry to sell. Sometimes I will sell. Sometimes I have open orders that are, let's say the bid ask is $3 and $3.50. I might have an open order to sell it beyond that, maybe at $4. So I may or may not ever get filled, which is fine. I'm trying to be careful and cautious and collect as much premium as possible. Okay. And so on down days, I may or may not get the premium we want. The other thing is don't be afraid to hold over earnings, especially if you have 30 days until expiration. Again, this is an advanced, intermediate to advanced strategy. You will get top dollar, as we saw, you will get top dollar for holding over earnings because you're also taking the liability of that piece as well, right? So high risk, high reward. Okay, so Ethan has a question about Shopify. Let's actually let me show you one more slide, guys, and we'll go look at that. The other thing is don't attempt to day trade the position after it's open. So some of you guys who are day traders, you may want to like tighten your stop, or you might want to do all kinds of things and try to wiggle out some profit. Just the best way to do it is let it work for you. Let it, especially if you have months, if you have 3 months to expire, give it some time to work for you. As we saw in our Fastly example that we walked through with Xochi, the stock kind of chopped around a bit as it was still going higher, but it's chopping around. So don't attempt to day trade it and try to get a quick gain and get in and out. Just let it work for you. The other thing is only sell when we have the minimum premium, right? Let's make sure we get our minimum. So if you guys think about it, if you're an insurance company and let's say that you are, you're going to insure 2 different things and you're going to get paid the same premium. Okay. What would you rather have? Would you rather have a 18-year-old male with a Ford Mustang convertible V8? Okay. That's one risk. Or a 32-year-old mother with a Honda Odyssey minivan. Which one, if you're getting paid the same, which one is a smart risk and which one's a careless risk, right? It would be which one? Right. The mom, the soccer mom, right? Because the risk factor. Now, obviously, young males have a bad reputation. So it is what it is. When I was younger, I paid a lot in insurance. I think I crossed the 25-year-old threshold. Your insurance premiums come lower. Now, that's not just insurance companies trying to pick on the guys. There's a statistical probability that that's how it is. Again, if you're taking a risk, you want to take a risk and you want to get your premium on a smart risk, not a careless risk. That getting the same premium on something like a Ford Mustang convertible, you could easily kind of lose your shirt on that if you're not careful, right? So on gap down days, collect typically higher than your minimum 1%, right? Okay, let's look at some tools. So FinViz, you guys know, this is my trading view indicator. And I do have a put log, which you guys can take a screenshot of that if you want that. I will share the slides with you, but let's jump into a couple quick examples. You wanted to look at Shopify. Does anyone have a specific time frame or just any point in time? You want to walk through it, or Lucian, how did you want to do that? Let's go back in time. Okay, let's go back in time. So again, guys, we have a dollar sign on this candle. Let's say we didn't get in. Let's look for another opportunity. I'm going to walk you through this and then we can be done. Okay. On this candle right here, ladies and gentlemen, does that meet our minimum criteria? Yes or no? So this is March of this year. right? So this is like before the COVID fall off the earth. So we all know what's going to happen. It's going to go and then just rocket higher, right? Okay, so let's take a candle or two. Ooh, it moved quicker than I thought it was. Okay, so what is our formula, guys, here? What are we looking for? We're looking for a $400 strike. And let's say we're going to do 2 months. So we're currently in March. So we're going to be looking for May expiration. We're going to be looking obviously at Shopify. What else? What else are we going to be looking for, guys? What else do we need to know? If we're May expiration, we're looking for 2% of our current price, which is 418, right? So we're going to be looking for how much premium? What's 2% of 418? Be $8.36, right? So in case, so here's a shortcut, guys. Just move the decimal two periods to the left, and that's what your 1%. And then if we're doing 2%, just multiply that times 2, right? Okay, so we are currently in March 9th, right? Let me scribble this down, March 9th. 400 strike, Shopify, and we're looking for a minimum of $8.36. Now, can everyone agree that this follows our strategy, yes or no? Does this follow our strategy? We're above the 200. We are in the money zone, right? We're going to get at least 836. We'll check here in just a second, right? We're good to go. So we're going to be looking for the May expiration. Okay. So let's jump into our think back machine and let's go on demand and let's take a look. And so let's go to March 9th of this year. So we're going to go to March 9th and let's just go to the end of the day. And let's take a look at Shopify. And again, guys, we're currently going back in time to March 9th, and we're going to go into May, our normal May options, 2%, right? So we're looking for a 400 strike, which would be right here. So ladies and gentlemen, do we get at least our minimum for $8.36? Yes or no? Yes, Steve, I typically use the regular monthly. I don't typically use weekly. I think at this point, Shopify did have some weekly options. They didn't usually, yeah, so they did. So typically in this example, we're using just the weekly. Okay, so we want to sell. How much premium, guys, in our midline here, how much would we collect? We'd collect $4,635 per contract. How many contracts do we want to sell? Let's do 100. No, let's not be careless. Let's do 1. JS says 0.5. So they got to be in increments of 1, JS. Yep. Thank you, JS. Yep. So we're going to sell this. We're going to collect 4,635. Now, what is our liability going to be, guys? We're going to sell a 400 strike put, and 400 times 100 is our, so we need $40,000, but we get a credit of 46.35. So our cost basis, not our cost basis, I'm sorry, our dollar amount would be, how would we figure that? We'd say 400 strike times 100 equals $40,000. And then we would collect a credit against that of 46.35. So 40,000 minus 46.35 is how much money we would need in our account to be able to sell this one contract, right? So 35,365. 35,365. 35,365. Now, if you don't have that much in your account and you're using margin, your broker will allow it. You're taking a risk bigger than your account size. Just be mindful of that. If you're using a retirement account is cash secured, right? That would be, you would obviously collect 35,000. I'm sorry, you would need cash secured. Your broker would put that money on hold, 35,365, but you're collecting $4,635. Okay. Is everyone with me? We're going to sell one at 46.35. You guys ready to do this? Okay, let's go. Let's send it. Boom. Magic number 1. Okay, so we sold it here. Let's roll forward a little bit. I want to show you guys this can get ugly quickly. Okay, boom. Now, in this case, guys, we are below our strike price. Yes. But again, keep in mind, we collected $46. So our $46.30. So 35 cents. So our per share. So we take 400 minus 46.35. And our 353 is basically our actual cost basis. So our actual cost basis, even though we sold here, is 353. You guys see how I came up with that? So I took our $400 strike minus the premium we collected, which was $46.35, obviously times 100 shares. I'm sorry, our cost base would be 353 and change, right? Okay. Does the high premium indicate a higher risk? Would you look for a spread or lower strike to help mitigate the risk? Yes. So, Jay, I could do, I think when you say spread, I think you're talking about like a bull put spread to mitigate the risk. I could do that. In this case, I didn't do that. Actually had this exact same thing set up in real time when this actually happened. So in this case, ladies and gentlemen, we closed really low. So let's take a look at what happened March 16th near the close. Let's look at our genius of a trade, and let's look at what could have happened to our account with our liability side of this. What do you guys think? What is it going to say? Obviously, we collected 4,635. Will probably be it's going to be a big red number. Again, you got to be careful when you're playing with fire. Okay, so now we're down. Can you guys see that? $5,540. Can someone, how many of you can stomach seeing that? I can see that. I could literally, I saw that number similar to that number today. I can be non-emotional. It is what it is. I'm executing my plan, right? $5,540. And I think that's not the lowest. I don't think that's the low. I think it goes a little lower. Ooh, we had a turnaround, sideways, sideways. You guys can see us consolidating for a little bit. Okay, so let's look at where we were May 24th. So obviously on these two, we have lower shadows. It went a little lower. So that number would have actually got a little bit more red. Let's take shoot, what day was that? May 24th. Let's take a look at May 24th. May 24th, near the end of the day. Our red number should be a little less red now, correct? You guys agree? Take a look. We were down 5,540. I'm guessing it'll probably get cut in half. Maybe down 2,500. Oh, we moved from negative to positive. Look at that, guys. Look at that. Partly because we went from being in the money, right? We're here, we're in the money on the put sale. We went from in the money to being out of the money, right? Yeah, see that? So our strategy says we can exit when we get a 50% premium has been evaporated. So let's roll. So if we sold it for $46.35, we're obviously looking for half of that. We're looking for $23 and change to buy it back at 50%. Let's see if we get some new highs, and we can check the date. So see what happens there. We went lower again, right? It looks like it's double bottoming a bit. What does the light green shaded area represent? So it represents the money zone, and we want to sell when it's kind of in this money zone, not necessarily below, but in our case, we want it to be, we want to sell when it's above our 200-day moving average. Okay. What about now, guys? Are we profitable on the trade? Probably, but not by much. What about now? April 14th. So the shutdowns are kind of in effect. The government's printing money. We're kind of digging our way into more debt, but the economy is rocking, right? So $690, I'm guessing it will probably be close to 50%. Ooh, look at that, ladies and gentlemen. we're looking for it at the most. We want to buy it back for as little as possible. Ladies and gentlemen, it is now $12. We sold it for $46.35. Does that meet our 50%? Yes or no? And again, this was one contract. You guys can see how if you sell 10 contracts, that could have really lit you up, could have gotten some deep trouble, right? So what would you guys like to do? Do you want to hold it? Do you want to sell it? One thing to keep in mind is that we sold a May 15th and we're 1 month away. We sold 2-month option and we're I would at this point I would probably close it myself. Personally, I would close this. Now, why would I close it? Because I had 2 months option and about 75% of the premium is gone in the first month. The most I can get is hold another month and get a little bit more, right? Get a little 25% more premium. But I want to sell it high and buy it back low. So in this case, I'm going to sell. I'm going to buy it to close. Now, one thing you got to make sure you're doing is you're buying the same amount of shares. So our midpoint here, the Thinkorswim is 1225. If we look at our bid ask, it's a little bit spready, 1180 and 1270, right? It's where your buyers and sellers say, I want to buy it for this amount. They're like, well, I want to sell it for this amount. And the midpoint is kind of the average in between. In this case, we are going to send it. We're going to close it out and we made a nice little gain. Now, let's talk about where I am right now in my options, where I am with, remove some drawings. All right, ladies and gentlemen, I have CrowdStrike is what I have right now. I sold the 110 on this day right here. Let's see the dollar amount. I don't remember exactly where it was, somewhere intraday after it reached the blue line. And I sold it for $4. It is currently just a little bit red. So obviously the difference between this line and this line. So just a little bit red. I sold the 110. So my cost basis is what? My cost basis is 106, kind of right here, right? Yep. Okay. So that is what I have open for CrowdStrike. And I have 3 contracts on that, right? No big deal. Matt's not going crazy. Matt used to go crazy. Matt is wizened up a little bit. All right, Datadog, one of my other favorites, Datadog. I sold the 85 and I got 350. Now, if we're talking about our strategy, we're in the money zone, or when I sold it, we were, and we still are. And I sold it on this day right here, I believe. It's a few days ago. Okay. 85 strike, 350. Obviously my cost basis is below at 81.50, right? So my cost basis is right about here. Okay. And this is my December. Again, you'll see that between CrowdStrike, CRWD, and this one we're talking about, both of these are December, right? They both expire December. That's the only ones that I have that are expiring in December. Okay, so I have 1 contract on Datadog, nothing crazy. Again, I'm tipping-toeing in because of elections of choppiness. Peloton. And again, all of these trades that are going to expire, I don't really plan to close them inside of the next, we got 1 or 2 more business days in October. I don't really plan to close these. So I plan to hold these and roll into the next month. Okay, Peloton. How many of you guys like Peloton? Peloton is one I really like. I got the January 100 put sale at $8. What is my cost basis? My cost basis is $92. So my cost basis right here, $92, right? Again, this is different than my December. So it's not possible for them all to be put to me at the same time. And I've sold 4 of those. Next is Fastly, which is the one that it looks the ugliest. It's not the prettiest. Fastly has, let's see, I sold the $70 put sale at 302. On this day right here, that little bitty, that candle right there with a little bit of wick, call it the doji with the beer belly, right? The high wave candle right here. I noticed this is what I call a volume pinch. So I noticed that it had a lot of selling. I'm sorry, a lot of buying on this day. You guys see this big volume candle. If you were to look to the left, it's the biggest. It's like the World Trade Center. It stands out tall above everything else. And I noticed, I said to myself, hey, if we close below the low of that, we're probably going to go lower. So me executing my plan, I sold, let's see, on this one, I have 3. I sold 3 put options and I bought some $80 strike puts. Now, that's kind of how I hedge. Obviously, if there's a market downturn, that's a kind of a different thing. But in this case, I bought $80 puts. Now, for those of you who pay attention to volume, do you guys understand why I call that a volume pinch? Meaning anyone who bought, including myself, I bought a couple, I think 200 shares at $88. So I closed the day up on this day. The next day I'm down, then down, then down, down, down. But good thing when I closed below the low of that candle right there, I knew we're going to probably go lower because all the people that bought thought they were buying the dip, right? We rolled over and went lower. That's right, Spencer. People were trapped. Absolutely. Yep. What date did you sell Fastly? I sold the November. Are you asking when I sold it? I think that's what you're asking. So I actually sold it right here on this day. And I sold the November strike. I'm sorry, the November expiration. Sorry. Yep. Again, we're above the 200. We're below the blue line and we got a green sign. And as you guys can see, I did not sell this strike. I sold a lower strike. Now, I do know several traders who kind of sold like right here, trying to chase. And again, you're not going to get tons of premium. So guys, if you collect $1 in premium, just a little bit when the previous day was like all-time high, you're not going to get lots of premium. And then imagine selling it for $1 and it's currently like $18, right? Your open P&L is going to be really, really red, really, really bad. Yep. So in my case, Albert, yes, it was below the green zone in this case. Yep. The green zone, the blue, dark green, sorry, the dark green line represents my strike price. Yep. What else? What strike put out would you buy Fastly now? What strike put would you buy for November? I actually already bought the 80. I bought the 80. It was slightly out of the money on this day right here. This black candle that's right beside the white candle. This guy. Because the volume pinch, I said I was looking at it. So most of you guys know when it comes to swing trading, I kind of block off an hour at the end of the day before the market closed. An hour before the market closed, I want to look at what are my open positions, and I do a review. Do I want to increase risk? Do I want to decrease risk? Are we going over earnings? In this case, you guys notice this was actually not even an earnings gap. You see that? And that's a pretty gnarly gap down. Now, yes, it did fade and went a little bit higher and then it rolled over. But that right there, I noticed the volume pinch, meaning if anyone who bought on that day, if we close below, they're automatically going to be upside down and we ended up rolling over. So near the close of that day, I bought $80 strike. So that trade is actually more green than the red on my down move. Now, at some point, if it's chopping around and consolidating, I might close the long put for a profit and continue holding the short put. Yep. Worst case scenario, I get put Fastly. That's $70. My cost base is obviously 67-ish. Yep. Matt, what about work? WKSH? I'm not sure. I don't know much about that. I think you mean workhorse or WKSH. No, I think you mean HS. Yeah. Don't know much about it. So I'd have to study it a little bit more to know if it's been on my watch. It's not on mine. Yep. What other questions you guys have? DKNG. Yep. You guys can see a lot of these are kind of below. When you see these stocks above the red line, which is good, and below the green, what does that tell you? The green line is 25%, right? So if they're down here, that probably means they're down almost 50% from the close of the highest close, right? So there's an 80% chance that it'll pull back 50% and a 50% chance it might pull back 80%. I'm sorry, I said it backwards. But Yep. So 50, in this case, when you get down here, you're kind of 50% below the all-time highs. Yep. And you guys can see it. So most of my strategies, I don't really use support and resistance because it's such a subjective thing. But if you think of support and resistance like traffic, and you guys can see that there's some congestion through here, right? Which tells me that there might be some buying that happens as you go through here. But if you look at as far as like a volume pinch, if we close, you guys have probably heard Jeremy say, if we close, if we close above DK and G, if we close above this candle right here, which is the biggest selling candle, if we close up above here, we might tease that area and then continue higher. But in this case, we're kind of in this congestion. This is like your LA traffic, right? Los Angeles, terrible traffic, right? Hold over earnings, that's up to you. You will get more premium for taking the risk of holding over earnings. If it gaps down to here and your strike price is up here, you're going to be underwater. There's no doubt about it. Yep. Okay. Any other questions? What if we don't have TradingView for the indicator? Steve, reach out to Thomas Wong if you use Thinkorswim. He took the code that makes this work and he converted it into ThinkScript for Thinkorswim. If you guys want to see the code, you're going to nerd out on it. This is kind of what it looks like. You guys can see that, but that's what it looks like. We're kind of looking for a pullback. We're looking for the recent high, blah, blah, blah. Yep. And then, yes, there is an alert setup in there. What other questions do you guys have? What if, hold over. So Patrick, you asked if it touched the 150 SMA today, might be looking to look into selling it tomorrow. I'm not sure which ticker symbol you're talking about. Okay. Any other questions, ladies and gentlemen? So I promised you guys I will put the strategy of this, the written out one, into the Slack channel. I'll do that as soon as we're done here. For those of you who are watching the recording, thank you so much for joining us. We will post the links for the indicator and the strategy as well. Thank you, ladies and gentlemen. Thank you for attending. We do have two more. I'm doing two more classes. I think it's two, yeah. So if you check our website, look at the event calendar. There are two more classes coming up. I'm talking about intro to swing trading live. So that's kind of like a beginner intro swing trading live. I'll be talking about my 10 EMA strategy, and then we'll do position trading, which is an advanced concept when you're trading stocks and options, kind of combining things together. I'll show you how I do that, how I protect my gains without actually selling the stock, right? Hold on to it and still protect it using collars. It's an advanced strategy. For those of you who are not familiar with that, we actually have a hedging with options. This class right here actually talks about how exactly I do that. And so that is coming soon to a theater near you. So if you haven't signed up yet, go ahead and sign up for these other classes. Again, it's the event calendar on our website. Thank you, ladies and gentlemen. Don't forget to love life, live life, and trade it. Thank you. Have a good night.